interim governor Hawksby. Now, this was very much widely expected, a 25 basis point cut, and the expectations is that we could see more cuts later this year. They have already cut 175 basis points since August of last year, and in their indications earlier this year in February, they had planned for cuts both in April and in May if conditions evolve as they had expected. So we are watching out for the New Zealand markets as well as the New Zealand dollar, last traded at 55.41. We've also got the Indian Central Bank decision due out this afternoon. About 2.5 hours from now, we'll be watching out for the RBI. Also taking a look at U.S. futures. They are lower as we count down to Trump's global reciprocal tariffs set to kick in under 2 hours from now at midnight Eastern time. China set to be the hardest hit with Trump's 104% tariffs after he slapped Beijing with a further 50% in the past few days in a tit-for-tat move. The president speaking at a Republican Congressional Committee event just a few hours ago.
After all of the abuses they've perpetrated, China is attempting to impose additional unjustified tariffs. Just so you understand, they all got rich because of tariffs. That's why additional tariffs on Chinese goods are in place effective midnight tonight at 104%. They want to make a deal. They really do. They want to make a deal. They just don't know how to get it started.
Trump's extra 50% tariff on China comes after China retaliated to his reciprocal tariffs with a 34% tariff. Treasury Secretary Scott Bessent telling CNBC Beijing made the wrong move.
I think it was a big mistake, this Chinese escalation, because they're playing with a pair of twos. Traditionally, if you look at the history of the trade negotiations, we are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Let's take a quick check, a deeper dive into how the Greater China markets are faring. Let's start with Hong Kong and China. Just in action now for about 30 minutes or so and back in decline. Of course, definitely a lot of nervousness that has recaptured the market after a rebound that we saw play out yesterday. The Shanghai Composite is traded off 1.6%. Shenzhen down on the day by 1%. We are watching, of course, as the National Stabilization Fund, or I should say the national team over in China, of course, keeping an eye out on the trading situation in the Chinese markets. And we had the likes of Central Huijin buying ETFs, all in a bid to support the Chinese market. The CSI 300 at 3,606. Flipping over to the Hong Kong markets, and after the first gain in 4 sessions, that was yesterday. Today we are back in the negative column, down 2% at 19,691. The Hang Seng Tech Index off 1.6%. Let's pull up some of the trade proxies because we are watching some of the key names like Lenovo, like Tektronix, companies that are huge exports into the U.S. market. Lenovo shares down 6.25%. Tektronix, which makes those power tools sold in Home Depot, down more than 2% as well. We also want to track what's happening in the Taiwan market because we did get a chance to hear from President Trump about the semiconductors. TSMC already announcing the $100 billion further investment into the United States alongside President Trump in the White House. That was with C.C. Wei. Now, he had this to say about Taiwan semis.
TSMC, I gave them no money. Great company, most powerful in the world, biggest chip company in the world. They're spending $200 billion in Arizona, building one of the biggest plants in the world. And that's without money. All I did is say, if you don't build your plant here, you're going to pay a big tax, 25, maybe 50, maybe 75, maybe 100%.
So we are tracking some of the weakness in the Taiwan market. TSMC shares are down on the session. Han Hai continuing to extend their losses. They closed down a 10% limit down yesterday. TSMC 814 last traded. Meantime, Main Street banks are projecting China will take a big hit from the trade war. Citi analysts have lowered their forecast on China's annual growth to 4.2%, down from an earlier 4.7%, adding that Beijing could ease policy rates significantly and add up to 1.5 trillion yuan in funding. Goldman Sachs also expecting policy easing from Beijing and flagging some downside to their 4.5% growth target for China. Let's get to our first guest. Perry Wong is Research Managing Director at the Milken Institute and joins me around the set here. Perry, a very good morning. Welcome to the China Connection.
Thank you for the invitation.
Now, it's really great to see you and get a chance to talk about this because China says that they are not going to be backing down and that they are going to be fighting on with these tariffs finally set to kick in a few hours from now. How do you think China is going to handle this, how they place themselves?
Oh, first I want to say, with trade war like this, absolutely no one wins. I think it's a perception of gaining something, but we all lose in long run. I think history has proved that's the case. And China, I think from my perspective, they are being backed to the corner, and there's no room for them to back down. It's not necessarily about the phase or whatever, but if you think about the starting point of trade war, that's 2018. That's about 20% tariff on Chinese goods, selective Chinese goods. Then entering the second term of President Trump, the first thing he did is 20% jack up. And then 54 and then now 50. So if you lump those numbers, add it up, just plainly add it up, that would eventually, I think effectively, an embargo of Chinese goods. So if you think about along that line, then Chinese government has no corner, nowhere to hide. So they have to, I guess, just stand there and say, okay, that's what it is, and we just need to prepare for the worst. And the worst is no trade, right? So that pretty much is come to be that point. I think in long run, and maybe at some point when the market suffered loss like this for another week or two, I think then perhaps there were consensus, not just American or the Chinese government. They have to, or the trading partner have to come together by saying we need to find a solution. I think that perhaps would be a global effort, my guess, to dismantle this destructive trade order, a new trade order, I would say.
Would you say a solution could see a decoupling?
I don't think, if truly the American leader and the Chinese leaders have the global market in mind, have the global prosperity in mind, then both of them and also all the trading partners should come to the table and say, okay, you look at the trade deficit as a pure number, you want to win, but you're not going to take all. So let's, as a global players, let's sit down and make a settlement of this. It's not just U.S. and China, because I think in some way the Chinese government learned from dealing with President Trump that he would change his terms. Right, this is not enough. I still need more money for the Treasury. And we can, maybe another $2 billion a day would be good, so $4 billion a day. So if you keep changing, at least by saying so, they will rattle the market, even if you don't do it, because investment is based on expectation and calculation of what's the risk and what's the gain. But having that kind of sentiment is not helping the investment communities. And I think beyond, dollar signs, really, we are playing with people's lives here. You are talking about consumer in U.S. are paying higher price on the goods, and we all know by studying economics, a tariff is a tax on their own citizens. So in other words, whatever dollar amount that the U.S. government is bringing in is almost bringing from taxing their own consumer or corporations. On the other hand, you have the developing Asia, China included, that the workers need to be paid and they want to have a better life. So you are talking about, at the end of the day, it's not just a dollar sign. It's about workers. It's about life. It's about economic growth. I think if we all understand that's at stake, then perhaps we can come to the table sooner.
Yeah, this is about people's livelihood.
Yep.
It is about companies also making money. And we're seeing reports here that China is urging Shein to halt the supply chain shift and instead to discourage diversification and rather source from other countries. Do you see that this is a viable solution?
I think not that direct, not that direct or easy to do. Because supply chain, I would like to use the analogy of, to break the rice bowl is easy, right? You throw it and then it's broken. But to remake that one takes a lot of time, and time is not something that anyone can afford. So it takes about 30, 40 years, or some say 50 years, to build the current supply chain, a truly global supply chain. And to rebuild it, I don't care whether it's China or US or anybody, to rebuild that would take not just 2 years, 4 years of President Trump's term, or say if President Trump can add another 4 years to the presidency, or 8 years, it would not be long enough to rebuild an effective, efficient supply chain. So the Chinese, I think, government, by some analysts count, that the Chinese government probably can come up with better answer into rebuild the supply chain, reroute certain goods. Yes, that's doable. But at the end of the day, you will compete against time and compete to people, livelihood, which is not, there's no easy answer.
What about hitting back with tariffs? Things like soybean, sorghum, U.S. poultry.
I think that's what the Chinese government is doing currently. But I think my question is, I think to the leader is, to what end? Right? You can only do so much. I think by the time then, if we play up the scenario as such, then I think that we will go back to the very question you asked. Are we going to have a decoupling in process, or maybe coming to the point that will just break? So now, break is a heavy word because that would imply both governments or governments would start to stipulate different scenario, and I think the ending is hard to say.
Now, a lot of this has to do with confidence, and that's why we're seeing the huge sell downs continue in the markets. And I've got to ask you about the private business confidence. To be able to invest in your own business, you have to be confident. We had the pleasure of speaking with Joe Tsai, chairman at Alibaba, at Converge Live. This was an event that was held by CNBC in Singapore. This is what Joe Tsai had to say a couple weeks back about confidence in China.
A few weeks ago, President Xi Jinping had a meeting with entrepreneurs, and people underestimate the importance of that meeting. What that meeting did to the entire entrepreneurial sector, or people that are the private business sector, is it gave private business people confidence to make investments in their business. I mean, we just came out and announced that over the next 3 years, we want to invest over $50 billion in compute infrastructure and AI, right? So it gave us the confidence that, to put our earnings back into CapEx and investments, and also hire people, right? So when private businesses have that confidence, they will take action.
Perry, this confidence that Joe is talking about, is it still alive and well in China?
I think so. If you recall, about 5 years ago, 4 years ago, the Chinese government came out with this policy, dual circulations. Now, that sounded strange. I mean, how are you going to run a country with the economy running on two tracks? But if you come to think about it, I think the Chinese government perhaps was preparing for the unpredictable, meaning the external condition or environment they cannot control. So to that end, they have extended their economic development package into regions that were less developed in China. So the wage rate and everything is lower, and also with abundant laborers. By shifting the resources that way, they would aim, I think the initial aim was to try to even out development or the equity, fair share of equitable distribution of income as such. But it turned out to be, by doing so, you can shield part of external shock. So that would at least place the Chinese investor or entrepreneur in some confidence that they know there is space to grow within the domestic market. To name one, for example, everyone will make a comment on the huge shift in demographic in China. So the population decline eventually would hurt the Chinese productive factors. But if you turn the table around by saying, okay, I missed the investment overseas, can I place the dollar, the yuan back in the Chinese market by finding way to take care of the gigantic two problem that the Chinese government have been contemplating, aging, demographic shifting. So by investing in that, you can come up with markets to address the demand. So that's one aspect of it. The other aspect I think the Chinese government focus on is how to enhance the production factors to make the production factor more effective, meaning you will higher return and equity. So that's important, incredibly important. And that's hiding in corners of the economic system. So by introducing technology, introducing AI, that would help to revert part of the money intent to invest overseas back to China. So that's one. Now, I think Joe actually mentioned the importance of have the domestic gas or the entrepreneur gathering in Beijing, and the government pretty much, in a way, I think encouraged them to try. And you have the government's backing, in other words, meaning just go out and try. Find the best way to do, and you guys are creative, so please do it. I think that's the message, plainly said. Anybody can understand. But I think I don't want to dismiss the meeting that the Chinese government organized during the China Development Forum, that meeting with the top business leader around the world to shore up the support from that corner of the world. So I think both meetings are important because you try to instill the confidence, I think, in Chinese government first. We believe our policy can address the difficulties and problems, and also we welcome you to believe in us, we can do it, and invest in China. I think both messages are very positive.
Perry, thank you for leaving your message with us today. It was a great pleasure to speak to you. We've been speaking with Perry Wong from the Milken Institute. For more on everything we've covered on our show this morning and deeper dives into the Greater China region, sign up for our China Connection newsletter, which is launching this afternoon. You can use the QR code currently on your screen. Coming up, countries including Japan and South Korea are lining up to cut deals with the U.S. We'll be live in Tokyo next and taking a look at the Nikkei as we head to break back in the red after that 6% jump in yesterday's session. We're looking at the Nikkei at 32,154. We'll be right back.
Journalism was always the perfect career for me. I've always been an egghead and a nerd. When I'm covering tech, my job is to really take these wonky and complicated topics and distill them down so anyone can understand. Ambition definitely fuels the tech industry. There's still this air of possibility when a new tech product comes out, that it can do anything, that can change the world. There's nothing better than breaking news, jumping on camera and telling everyone immediately what they need to know. I love what I do. No day is the same. I couldn't imagine doing anything else.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fought for them.
I believe in getting justice.
American Greed on CNBC.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
Welcome back to the China Connection. President Trump saying in a post on Truth Social overnight that he had a great call with South Korea's acting president Han Duck-soo, touting a potential great deal covering tariffs, shipbuilding, the LNG pipeline, as well as military protection that the U.S. provides. This is the latest in what Trump says is a long line of countries willing to talk trade.
In addition, we have a lot of countries coming to see us that want to make a deal. And we're doing things that nobody's ever even thought about doing.
Meanwhile, U.S.-Japan trade talks are kicking off in D.C. this week. CNBC's Kaori Njoji is tracking those talks and joins us live from Tokyo. Kaori, good morning.
Good morning, Emily. Well, this interview with the U.S. Trade Secretary Bassett is very, very clear on what they are looking at in terms of negotiating with their counterparts in Japan. Take a listen.
Look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
Critical, Emily, that the first thing he mentions is the military alliance, because I think there is where some of the negotiation really is going to happen. I mean, Japan bought a lot of Tomahawks recently. It buys a lot of U.S. military equipment as well. And in terms of dollar value, I think that's where people are focused on in terms of really actually being able to make a significant dent in what the U.S. says is a gross imbalance. But some of the other comments from that interview are fairly telling as well. I mean, look, he says outright there is talk of a big energy deal in Alaska where the Japanese will take a lot of the financing for the deal. I mean, this is a $44 billion natural gas project. So an Alaskan delegation visited Japan recently. Mitsubishi Corporation, the CEO, has said that they might be involved in that. I mean, they're dropping big hints.
Kaori, we're also looking at how defense and economy are bedfellows in the U.S.-Japan relationship. What do you make of it?
Yeah, I mean, this has always been the case because Japan has no military technically, and it depends on the U.S. for its security safety. So I think that goes lock in step. That's the left hand. And on the right hand, you have the car companies, Toyota Inc., and all of the companies that are attached to that. So I think this is going to be a package deal. And I think it is very immature, and I don't think anyone in Japanese politics and Japanese corporations think that this is going to be just the only part of the package. I think they're going to come up with a lot of independent stimulus measures here at home to try and buffet this very fragile economy, Emily.
You know, this wouldn't be the first time that Trump and Ishiba would have their meeting. Do you expect any difference to the success that he had in his first meeting?
Well, the first time around, remember, they did some deals on beef. I don't know how much more they can do on that. I think there is always some sentimental interest in trying to get more agricultural products into Japan at lower tariffs, but there's a limit to that as well. I think the car story in terms of getting U.S. cars to the Japanese market is a romantic notion. I mean, look, anecdotally, the only U.S. car I see on the streets here in Tokyo is a Jeep. And I looked at the numbers, and they sell about 10,000 cars. That is nothing here in the Japanese market. We drive on the different side of the road. Practically, it's just the roads are really, really narrow here, and the U.S. cars don't fit. So I think that is a very romantic notion, if anyone is entertaining that. I think something closer to reality would be something like the LNG products and maybe some of the industrial products, which I hear some of the U.S. Trade negotiators are discussing as well, because that's a big ticket item in terms of imports for the Japan side.
Kaori Njoji, thank you very much. Reporting live from Tokyo. Coming up, the EU calling on China to work together to ensure stability in the face of Trump's tariffs. We will be speaking to the president of the EU Chamber of Commerce in China next.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
The top fintech companies list is back. CNBC and Statista are looking for the world's standout firms, following in the footsteps of some of the biggest industry players. To find out more and submit your application, head over to cnbc.com.
Leaders from the world of sport talk tech.
You have technology that is now allowing coaches to reduce the risk of injury.
AI gaming is going to be one of the most fundamental disruptions.
And new growth opportunities.
There's an opportunity for us to come together, for players to play across different platforms. I think that's really wonderful.
What do you do while you're watching sports? Not everybody likes the lean back experience. People like to lean forward and engage. Highlights from Converge Live, only on CNBC.
And you're looking at a snapshot of all the market action across Asia. It is largely negative with the biggest downside playing out through the Nikkei 225 on the board here, down 2.6%. A couple spots of green coming through from the Philippines and the Jakarta Composite. Let's move over to the Greater China markets. And after a day of rebound yesterday, we are still seeing some red on the board. Notable is the Hang Seng Index down 1.7%. And of course, an extension of losses for the TAIEX as well. The last couple of sessions since Monday now, we're seeing losses on the TAIEX in excess of 15% as they play catch up. And of course, with the latest commentary to come through from President Trump about the potential tariffs that would be slapped on TSMC if they do not follow through with their investment in building out over in the United States. So they have committed $100 billion and expected, of course, further construction and even an R&D center in Phoenix, Arizona. From Tokyo to the EU, countries are scrambling to respond to Trump's reciprocal tariffs that will go into effect in less than 2 hours. The EU is prioritizing negotiations even as it prepares to retaliate with a 25% tariff on some U.S. imports. CNBC's Sylvia Amaro has this report.
European member states are voting this Wednesday on new tariffs against the United States. This in response to the U.S. announcement of tariffs on European steel and aluminium. But at the same time, the European Union is already working on more measures against U.S. products after Donald Trump, the President of the United States, announced last week additional tariffs on European goods of 20%. However, ultimately, what the EU wants is a compromise. They want a deal that will prevent, if not all, at least some of these trade tariffs. In the meantime, however, these trade tensions are already having an impact on European economies. Here in Italy, we are in Tuscany, one of the most famous wine regions of Italy, and two Italian wine producers told me that some American importers have already paused orders as they await further clarity on the trade front. For CNBC Business News, I'm Sylvia Amaro in Siena, Italy.
Meanwhile, European Commission President Ursula von der Leyen spoke to Chinese Premier Li Qiang overnight. In a statement, her office highlighted that both Europe and China need to negotiate responsibly for a strong, free, and fair trading system. Jens Eskelund is president at the European Union Chamber of Commerce in China and now joins us live from the mainland. Jens, very good morning to you and thanks for joining us today. If we can start our discussion this morning about the EU businesses that are operating in China at the moment. Of course, we are waiting on the further additional tariffs to kick in at the middle of the day, 12 noon Beijing, Hong Kong time. What is the feeling there? What are you hearing from the businesses?
I mean, this is completely uncharted territory, this radical unpredictability. Maybe we had 2 or 3 days in connection with the financial crisis and the Lehman bust, but we have not seen anything like this before, and the ground seems to be shifting on us literally as we speak. And every morning when we wake up, there seems to be another piece of bad news or something that we had not anticipated. I think we are perhaps mentally a little bit more prepared than we were before. We have been through a number of black swan events in the past. We had COVID, we had Russia's war in Ukraine, we had the Red Sea and so on. So I think we are already at a sort of a high level of alertness and adaptability. But there's no doubt this is very, very difficult, and everyone is scrambling for answers and trying to figure out, how can we position ourselves and minimize the impact on our activities and on our customers.
The EU is a top trading partner of that of China when it comes to both imports and exports. Is there room for the two countries to further work together?
I think so, absolutely. I mean, we celebrate the 50th anniversary of relations between EU and China this year, and it is a relationship that has created enormous value in the past. And we believe that there is a significant potential going forward. But also, there needs to be adjustments to the model. There is, for good reason, I think, a perception in Europe that the benefits of the collaboration are not divided in an equitable manner. So I think there needs to be a service check of the model, and maybe the 50th anniversary is a good opportunity. We see trade imbalances growing and growing, and I don't think that you will ever have balance, but maybe we need to look at some of these issues that are creating concern in Europe today. And likewise, Europe obviously need to also be thoughtful and listen to what China has of concerns. I think the key thing is now that the parties are sitting down, and I think it was good to see the meeting between von der Leyen and Li Qiang yesterday. So let's keep the dialogue and conversation going.
In terms of that dialogue, be it regional or bilateral, of course, the EU says it is working on agreements with Australia, South Korea, New Zealand, and even Vietnam. Is there place for an agreement with China?
We hope so over time. I think the old investment agreement that was put on the table down in 2020, we are living in a different world now, and I don't think it would be anything similar to that. But we appreciate the efforts to try to reach agreements, and to the extent that it's possible to formalize that is, of course, a good thing for business. We like predictability, we like reliability, and that is one of the things that trade agreements can do. So we're very supportive of the Commission's efforts to go out and create some of these agreements. It needs to be something that works for EU, it needs to be something that works from the other party, and I think if we sort of get in the right frame of mind, something can be worked out with China as well.
I had the pleasure of speaking to the president of AmCham Shanghai just yesterday, Eric Zhang. He was talking about the trading relationship between the U.S. and China. If we can listen in first.
There's been an 8 percentage point drop in China's total share in U.S. imports. So I think that direction will continue, and China will probably have to find other markets outside of the U.S. For the U.S. consumers, unfortunately, it will mean that you will have fewer choices and higher prices.
He's talking about China having to find other markets outside of the United States to send its goods. Is there any concern now? There's reports about China's goods bound for the United States now being diverted to the EU at discount prices. Sometimes we're talking about overcapacity in terms of the products coming out from China, which could put pressure on the local economies in your bloc.
Absolutely, and I think this is one of the issues that China needs to be alert to. We have seen now 29 consecutive months of deflation in China, and that means that you can send many more products to China for fewer dollars or euros. So you need to look at the volume perspective also. And if you look at container traffic, for example, which I think is a good proxy for trade in manufactured goods, accounting for 80 to 90% of trade in manufactured goods, we can see now that every time Europe ships one container to China, China is shipping more than 4 containers to Europe. And if we look just at last year, the first 11 months, China's export in container terms to Europe actually increased by 13%. 13% in what is basically a zero growth market. At the same time, you have a Chinese economy that grows by 5%, and in that period, EU exports to China in volume terms actually decreased by 9%. I think it's very concerning that you can see over the past 5 years, the Chinese economy has perhaps grown by 35% since 2019, but in volume terms, European exports to China have declined by 29%, whereas Chinese exports to Europe have increased by 26%. Obviously, that direction of travel cannot continue. And I think it's very important that China realizes that you need to find a mechanism where you create a better balance, and also that Europe simply will not be able to absorb large amounts of trade being diverted from the US to Europe. The answer, of course, is that China begin to work on creating domestic demand. That is by far the biggest issue right now. That is that Chinese customers, Chinese consumers are simply not picking up all the goods being produced. That leads to deflation. That leads to pressure on exports, and that leads to the situation now where you have an acceleration in imbalances.
Jens, I want to ask you, in your capacity as the managing director of Maersk China, the Trump port fees that he wants to impose on China for China-made and linked ships in excess of $3 million. This is an incentive to bring shipbuilding, the manufacturing, back to the United States. Does this make sense to you?
We understand, of course, that there are security considerations if you don't have a domestic naval industry. It's hard to see how you can have an efficient naval military shipbuilding industry if you don't have a civil shipbuilding industry. But I think when you look at China, we can see that this is a generational effort. I mean, China has spent 20, 25 years to get to where it is today. So I don't think that there are any quick fixes. And I think the way that it has proposed right now, let's see how it ends. We don't have a clear view yet of how it stacks up, but I think that this is really something that is going to take a long time, a lot of effort, and not something that is going to get fixed in the short term.
For Maersk, how many ships, or what is the number of ships that are made in China, if any?
No, but China is by far the biggest shipbuilder, and I think that last year China accounted for something of 70% of all orders of large ships being ordered globally. So there is really no nation that is comparable to China. And I think in particular within the container segment, you see going forward that the orders already placed are at a very, very high level. I think something like 80 to 90% of container vessels going forward by the entire industry are placed in China. So clearly, this is something that could be very disruptive. We understand the thinking behind why you want to sort of de-risk yourself in terms of not being overly reliant on one manufacturer, but we also urge companies to be careful, because if this is not done in the right way, this is something that could again disrupt both trade and the ability of service providers to deliver cost-efficient solutions to our customers.
I want to get your insight on CK Hutchison and the port sale that they are trying to push through to that of BlackRock. Of course, there's been a lot of resistance from China. The deal effectively on hold right now. What would the implications, what would the impact be if they were successful in selling their Cristobal and Balboa ports, of course, alongside the other ports around the world?
I don't have any particular insights to how this is unfolding, and I think it's important to keep separate what's happening on the operational side and what is happening on the asset owning side. We don't have reason to believe right now that this is something that is going to affect the normal running of our business. We are, of course, following how this develops and unfolds, and we will have to see.
Jens, thank you very much for your time today, and of course talking through so many important aspects from trade and of course the political hot potato that we're watching with CK Hutchison. Jens Eskelund from the European Union Chamber of Commerce in China. Coming up, we'll discuss how the market rout has impacted private markets and if Beijing's stabilization efforts will be enough to shield the sector in China.
CNBC. Live ambitiously.
My desire to keep learning, that is what drives my ambition. I sought a career change after 5 years working in corporate law to pursue a passion, which is to tell people stories and help our audiences make sense of the world that we live in.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Embrace digital disruption.
I mean, this is life-changing technology.
CNBC Tech, The Edge, only on CNBC.
Global markets, up to the minute, front page news. Wake up to Frank Holland and Worldwide Exchange. CNBC.
Today on the China Connection, we're tracking the flow of private money. The downturn in the public markets has sparked a race for liquidity in the private markets. Major institutional investors have seen nearly 20% declines in the past week alone, battering their portfolios, and according to the Financial Times, they're looking to offload stakes in private equity funds in a sign of liquidity pressure not seen since the 2008 financial crisis or the COVID pandemic. It comes off a year where deal making plunged more than 20%. China was not immune from that. According to S&P Global, fundraising for China-focused funds last year decreased sharply, with investors looking towards other Asian markets. Some of that's due to a perceived lack of government support for emerging firms. But sentiment turned around last month when Beijing announced a 1 trillion yuan government-backed fund focused on investing in tech like AI, renewable energy, and even quantum computing. Will that be enough, though, to hold things up for China's private markets in the current environment? Let's get more on that with James Tam. He is private equity partner at Bain Capital and joins me around the set. James, a very good morning to you.
Pleasure, my pleasure.
I first want to start our conversation. Let's talk about the impact to the PE landscape with all that's going on, the developments on a daily basis with the trade tariffs and the trade war that was launched by President Trump.
Yeah, obviously it's a shock to everybody in the world, not just among private equity professionals, but it's a broader market as well, obviously. And the first thing we think about is not necessarily new investment at this point. I think the focus of private equity firms, because we also hold a big portfolio of companies. The first thing first is to ensure that our portfolio companies can operate smoothly in turbulent environment, and how do we cope with the volatility as it goes on? Because we do see that this is kind of the beginning of what may happen further down the road. So I think this is something about preparations and preparing our portfolio companies to weather the storm. That's top of mind right now.
Is there any signs of distress amongst your portfolio?
So far, no. I would say that because it's still early, obviously the tariffs are just about to go into place and people are still assessing the impact and people are still figuring out how things will move. But obviously, it's a tariff on the exports to the U.S. Many of our portfolio companies still have a big part of the domestic businesses in their own countries, as well as exports to other countries, which are not affected by this round of tariff. So I would say that obviously different companies have different exposure to the U.S. market, some more, some less. But overall speaking, I would say it's a balanced portfolio that we have right now. And while there will be impact, I think it's still manageable.
Now, this report that we're seeing in the FT about some institutional investors wanting to shy away or even shed their stakes in illiquid PE funds, are you seeing any of that?
I think it's still very early days. I think we were all shocked, just less than a week ago, and we are kind of getting into it. Of course, as things go on, we'll see what happens. Obviously, there are also trade negotiations happening that can mitigate some of the impact. We'll wait and see. But even if there are more direct impact on some of the businesses, I would say that many of our portfolio companies are healthy enough to weather this kind of storm. Not to say that there is no impact. Obviously, there will be impact. But I think it's the resilience and the strength of these companies that matter in times like this.
And what about in terms of a portfolio? Would this be a time to just sit tight, or would you continue to look for new investments?
Yeah, I think in the very near term, it's probably time to sit tight first and exercise more caution. I think we'll need to see how the dust settles a bit and see how this plays out a bit more. And I think it's clear that the supply chains will be restructured in one way or another. We still do not know yet how exactly they will be restructured. But we have seen these volatilities before. Usually these volatilities happen, there will be repercussions in the market, but the markets are not static and the supply chains are not static, and companies are all trying their best to mitigate and manage the situation. So the supply chains will evolve and people will make their moves and they will adjust themselves to manage the situation.
How are things looking in Greater China? Are you able to put your cash to work?
Well, we have been putting our cash to work. We have been investing into Greater China, but we also operate as an Asian fund. So we also invest a lot in Japan, in India, in Australia, in Korea. And of course, China is an important component of our portfolio because just the sheer size of the economy in itself. But I would say that, first of all, it's a diversified portfolio that we have in Asia. But China being a big economy, again, will have impact. But it's about how we manage and balance it out.
And so you mentioned some other markets, India, Japan. Has China lost some of its luster compared to other regions?
I would say over the last couple of years, obviously, we have all seen the Chinese economic downturn. That has led to a pivot of focus away from China towards India, towards Japan. And we have been investing a lot in those countries as well. But also, don't forget that as of 2 weeks ago, we were all talking about DeepSeek, we were all talking about humanoids and all these things. These things are still there. Of course, it's not the topic for today to talk about this, and people may not be interested and so keen to put money to work at this moment. But I think a lot of the advancements that we've been talking about over the last couple of months are continuing. And I think these are all structural factors that will contribute to the long-term development, not just for China, but for the Asian and the global economy as well.
So the AI trend remains intact. I want to ask you about the confidence. We heard from Joe Tsai in a soundbite earlier. He was speaking to us at CNBC's Converge Live event in March, where he was talking about the President Xi Jinping Symposium. And when he met with the tech entrepreneurs, the business leaders, that this reinstilled confidence for them to reinvest back into their business. Is that confidence, can you still feel it in China?
I would say, of course, the shock has just happened. And as of last week and as of 2 weeks ago, I think people were getting more confident about the Chinese economic outlook, as well as the possibility to deploy new capital into China as well. Obviously, it comes a big shock, and it's a supply chain shock. It's a different type of shock than other things. So we need to separate things a bit, because right now, there is a clear potential for supply chain realignment, but it doesn't mean that other sectors are slowing or not developing. So I would say that over time, people will settle down, look at the facts and reassess the situation, know that which sectors will be more impacted, certain will be less so, and certain will have even more growth potential. Because the U.S. account for roughly 15% of Chinese exports as of last year. There are still good 85% to other places that are not impacted by the U.S. tariffs. So, of course, 15% still account for hundreds of billions of dollars. That's still a lot. But you are talking about even thousands of billions, trillions of exports to other places. Now, China will think about how to redirect some of the U.S. exports to other places or consume domestically. As we all heard about potential for domestic stimulation on consumption, etc. So those would be helpful factors as we move along to see how we can begin more constructive on the economic development going forward.
And you talk about sectors. Are there any ones that you're particularly looking at or are excited about?
I would say right now we look at it on a very balanced perspective. We look at industrial, we look at technology, we look at consumption as well as healthcare. I think each sector presents its own set of opportunities. So I would say, overall speaking, I think there are still good opportunities around. But is it the right moment for us to deploy right now? Probably we would exercise more caution, and let's see how things play out before we really decide to deploy.
The government announced its own 138 billion U.S. or 1 trillion yuan semiconductor renewable energy. They're looking at different support for the tech startups. Does that give you encouragement, or is that competition?
Yeah, no, it certainly gives us encouragement, because we think that these are long-term structural growth factors. And there are industries that would require more investment, and the Chinese government has been focused on developing them. Of course, we need to take into account the global context on what that means as a result of this trade dynamics with the U.S. and other countries. But I say that these are structural upgrades happening not just in China, actually. It's actually in broader Asia. That's why we are long-term bullish on Asia. So our position is we are long-term bullish on Asia, and there will be periods of volatility in each country. And obviously, people's focus may be more on China and the tariff impact on China right now. And then, we are shifting our investment focus to other countries to compensate for that. But overall, if you look at the macro trends of Asia, we Bain Capital have been investing for 20 years in Asia. So we have seen some ups and downs, and we have fairly seasoned professionals in the business. So I would say that we have seen this movie, and these markets come and go a bit. But when the dust settles, there will be renewed opportunities. That's our conviction.
James, I wish we had more time, but the show is about to finish, so we'll have to leave our conversation there for now. Thank you very much for being with us today. We've been speaking with James Tam from Bain Capital, and that'll do it for this edition of the China Connection. I'm Emily Tan in Hong Kong. Keep it here on CNBC. Inside India is coming up next.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC. We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
This is a good global debate.
There is no place in the world where we get the kind of access to so many amazing interviews.
To be able to solve problems at a scale that nobody's ever imagined.
This industry is going through its renaissance.
How big a game changer is this?
Let's go.
I see ambition as enriching your entire life. Your financial life, your personal life, and the lives of people around you, your community. My ambition is to build people up.
Before I go out, for me, the more relaxed I can be, the better. As soon as I try and create that situation where I'm tense, I'm like, okay, something big's about to happen, I need to do this. That's when I just don't perform to the level that I need to. And maybe that works differently for other people, and other people, you know, they go and have a kick with a football, or they go do some boxing and they get hyped up. You see their warm-ups, they're getting sweaty, and I'm just lying there having a little nap.
I can't believe that landed. What, you can have a nap before?
I'll have a nap. Yeah, it's like the lower my heart rate, the better I'm going to do. Because when I get in the car, you know, as soon as the helmet goes on, you're in your own world. It's me, it's my car, everything's disappeared, and it's just you have to focus on what's ahead of you. I'm still nervous, I'm still crazy nervous before races. I'm an overthinker, so I think of a lot of stuff. So the more I can almost calm myself down and just think, okay, all I got to focus on is the start. Then after the start, the rest will happen.
Before they talk to Wall Street, they talk to John Ford and Morgan Brown. Closing bell overtime.
Sastrikant, welcome and good morning, everybody. Choppy trading in Asia as we are 1 hour away from Trump's sweeping reciprocal tariffs kicking in, including a 104% rate on China. But countries, including India, are lining up to cut trade deals with the United States to lower those tariffs. All of which makes for some tricky decision-making for the Reserve Bank of India, widely expected to cut by 25 basis points today. But could it signal a willingness to do more? Good morning, everybody. Welcome to Inside India. The markets in India join us in about 45 minutes' time. The Nifty did close 1.7% higher yesterday. Gift Nifty futures are indicating a lower open driven by the global equity sell-off that continues due to escalating tariff tensions. And as we mentioned in the headline, a little over an hour to go before 104% US tariffs on China take effect shortly after midnight. So that has implications for India, arguably quite possibly in a positive direction, because that tariff differential with the rest of the world, including India, just continues to widen, arguably in India's favour. Let's wait and see. We are also continuing to watch the currency markets, the rupee, which strengthened about 2% in the last month, but weakening again ahead of the RBI decision today. Quick check on the bond market and the benchmark India 10-year bond yielding just under 6.5%. 25 basis point cut expected by the RBI, but the outlier is a front loading of a bigger cut of 50, not a base case for many, and if that did materialise, it could very well be counterproductive and could well panic the market. Markets also watching out for revisions in the growth projections and any shift in the wording of the policy stance from neutral to accommodative. Also, let's take a look at US equity futures, which are lower as we count down to Trump's global reciprocal tariffs set to kick in under 2 hours from now at midnight Eastern time. China's set to be the hardest hit with Trump's 104% tariffs after he slapped Beijing with a further 50% in the past few days in a tit-for-tat move. The president speaking at a Republican Congressional Committee event just a few hours ago.
After all of the abuses they've perpetrated, China's attempting to impose additional unjustified tariffs. Just so you understand, they all got rich because of tariffs. That's why additional tariffs on Chinese goods are in place effective midnight tonight at 104%. They want to make a deal. They really do. They want to make a deal. They just don't know how to get it started.
Trump's other reciprocal tariffs also kick in at the top of the next hour. U.S. Trade Representative Jamieson Greer telling the U.S. Senate overnight that Trump will not have any exclusions or exemptions, even as countries line up to seek some reprieve.
Other countries signaled that they'd like to find a path forward on reciprocity. China has not said that, and we will see where that goes. I think we need to work with our closest friends to make sure that we have trading arrangements that work. And if the Chinese are open, we'll see what. But they haven't signaled that at all. So I don't think that's in the very near term with China.
26% duties on Indian imports come into effect at the top of the hour, and India is just one of the countries negotiating a trade deal with the US. But Finance Minister Nirmala Sitharaman says the government is seeking bilateral trade deals with other countries. She's currently in London to speak with the UK Chancellor Rachel Reeves. And one area that India could potentially benefit from, iPhone shipments. The country's technology minister saying it exported 50% more iPhones in the last fiscal year. Apple had been turning more towards India as a manufacturing base since COVID disrupted supply chains in China. A lot of dimensions to the macro markets as they apply to India. Let's bring in Sanjay Nair now, president of ASSOCHAM, the Associated Chambers of Commerce and Industry of India. Sanjay, thank you for joining me. Would it help confidence amongst your members if the RBI cuts the repo rate by 25 basis points expected and quite possibly signals a commitment to do more?
I think the members are pretty bullish about it, and I think they're quite positive that it's going to happen. And I think that is probably feeding into the system itself. I personally felt that maybe they should adopt a wait-and-watch policy because what we need is more liquidity, which they've injected quite considerably. And as you know, the rate transmission in India is not extremely efficient, and in fact, banks are still struggling to get high-quality deposits. So I'm not sure what it does, except obviously we need lower cost of capital. But, frankly, we need to see folks borrowing and using it for corporate capex, not just for personal consumption. And that's my little bit of worry. But look, a rate cut is always welcome otherwise.
Understood. In the current environment, Sanjay, do you feel that 6.7% headline growth is now at risk?
For FY25, I think you have 6.4 in the bag, I think. I'm not, again, much in the know the inside, but I would say that a couple of years, 2 years out, you should see 10 to 11, maybe 11.5% nominal growth. So I would say 6.5 to 7, I would say is a base case for 26, 27. And of course, there are many uncertainties, which I'm sure we'll talk about.
Let's talk about that. How then would you characterize sentiment, confidence amongst your membership, Sanjay, and are your members at this stage inclined to put capex, hiring, expansion plans on hold, or is it business as usual for them?
I think for the time being, it's business as usual. I think it's too early. When our members just take a step back, and also folks like us from the corporate world, we just have to see that India itself is a massive local opportunity. And the government here in the last couple of years has driven 3-4 things which are very important to note, right? The whole formalization of the economy, the digitization, the GST rationalization, and the PLI, the production incentives they gave. Plus, we are fast-tracking a lot of FTAs. 3 are done, 3 or 4. They're on kind of a war path to get a few more done. which they were doing even before the announcement. So I think they have been very proactive on that. So leave that as it is. And then you look at a huge domestic economy, which may not be firing on all cylinders, honestly, especially consumption. So I think that if the government will wait and bridge another 6 months to a year of infra spending and the government expenditure, and then crowd in the private capex,
yes,
I think that's when the members will really begin to see the green shoots, because private capex is still not picking up to the tune it should. And maybe it's got to do with the old adage, ease of doing business or whatever. And I think that's a bit overdone. We got to get very specific. What are the issues? And those are being addressed head on. So I would say nothing has changed per se, but we cannot be sanguine about what's going on. At least I'm not. And I think we need to act both on the government side, because they're doing a lot, and the private sector really needs to step in.
Can you give us a bit more detail, Sanjay, about the challenges domestically, and how deep is the consumer stress at the moment? And would you go as far as saying that this is a consumer confidence crisis, and what can be done to arrest it?
No, I don't think it's a consumer confidence crisis. I think the household debt has gone up, and obviously the regulators are extremely watchful, so are the banks. I think the larger issue is job creation, wage growth, and a secular trend pickup, which you should see as a result of that in consumption. You see a lot of cyclical ups and downs, but you got to see a secular pickup in consumption, and that is the key. So I think we should not misunderstand low consumption with household stress. I think folks are trying to save to repay the loans, and I think the first cut that will come because of this budget announcement of making the first slab tax-free gives people 30 to 40,000 rupees in their pocket. I think they're going to try to repay the debt and then sort of begin the consumption cycle. But
yes,
frankly, ultimately you need job creation and wage increases, which is really what will lead to a secular pickup in consumption. And when corporates see a secular pickup in consumption and 70, 80, 82% of secular capacity utilization, that's when the private starts. And I think we're just there. But again, with this whole tariff thing, I think people need to recalibrate a little bit more.
Of course. And Sanjay, in a global environment where there seems to be a non-trivial risk now of stagflation, do you feel that a recurrence or inflation making a comeback in India, and there are signs that inflation is starting to stabilize, is something that you are concerned about, or the fact that oil seems to be relatively suppressed at these levels works in India's favor from an inflation point of view?
Yeah, I'm frankly personally less worried about inflation, and you'll hear, I'm sure, the RBI statement as well. I don't know what they've seen. Oil prices really help. There's no doubt about that. I think the rupee has not weakened as much as some others have, and that helps a little bit. The inflation also earlier has been quite supply side bottleneck, that's why. And I think the supply side in this country in the last 4 years, with the amount of spending being done by the government on physical, social, financial infrastructure, the digitization, the supply side is far more debottlenecked. Of course, the agrarian economy is always up and down given climate change and given all the fragmented issues we have on the farm sector. But I would say if food can remain under control, I think oil, currency, and the supply side impetus that this government has given should really help us go through a period where inflation should not be the concern.
Understood. Sanjay, let's pivot back to the external landscape and situation. How supportive is ASSOCHAM of a US-India bilateral trade agreement, and how material do you think that would be for India's export revenue?
Look, I think it's very critical, and this may be a call to action. This government was already in action mode, like I said, in terms of closing out FTAs, but now the PTA with US becomes, I think, extremely critical. 18% of our merchandise exports out of the US. It's not a small number. It'll be foolish to say we will not be impacted. I think we will be impacted. So the BTA is one way to clearly get some uncertainty out of the way. What is clear is that tariffs will have to come down, that we impose both non-trade and trade, which again means that the companies will have to become a lot more competitive, and there is no shielding. away from the real competition that they're going to face. So that's number one. Number two, I think they will strategic their supply chains, which is good. The China plus one factor plays in our favor. You see what Apple exports are. I just saw it on your screen. We will have
Sanjay, can I just interrupt you on that score? It's very interesting what you said about Apple. And do you feel that Apple is close to doubling down on India as a manufacturing hub? And where then are you putting FDI in the next 6 to 12 months?
I think so. You're going to ask the US guys how they think about it, but I see no reason why they would not have a reliable manufacturing partner in India, whatever the value add be. And that value add is going to keep increasing as they get more comfortable with India. And I think India's resilience and consistency that has been now evidenced by Apple should encourage more FDI. So that's just a kind of a brief answer.
Sure.
So,
Sanjay,
you want me to come back? Yeah, sorry. Go ahead.
Sorry if I can. And it's always a fascinating conversation, isn't it? When we're in an environment where India continues to restrict market access for BYD, but many are now openly saying that India and China should stand together in the face of US tariffs. I'm curious, does your membership share that view?
We source a lot of stuff from China, right? And I think we should not, I think at least, be too worried about value-added capital flow, investment creating flow, capex creating capital flow, and technology. And China should be, I think, treated, leaving out the political and the geopolitical issues, just theoretically as a banker or as a financial markets person. I think where we get capital and technology, we should welcome that. That's my view. Our members wouldn't be concerned, frankly, because they're always more concerned if the imports get cut off for whatever reason, because we import a lot from China. So I think that there is a bilateral positivity in managing that relationship, being a little bit more open. Yeah, you don't have to open up critical sectors and sell your companies, but there's a lot more that we could benefit from China.
Sanjay, IT services, pharmaceuticals, car makers like Tata Motors stand to be most affected by the tariffs. Can you give us a sense of how ASSOCHAM and your membership is now actively engaged, perhaps, in looking at new markets, alternative markets, building on existing partnerships? And we know that Finance Minister Sitharaman is already in the UK having discussions with Chancellor Reeves. Existing partnerships in Europe, South America, Africa, and ASEAN as an offset. What progress are you making?
So break it into two parts, okay?
Sure.
Where we need to get technology and innovation, I think the EFTA FTA with Switzerland, the 4 countries, Switzerland, Norway, Liechtenstein, Iceland, is an excellent one. I was recently in Switzerland, and you just see the kind of innovation going on there. And we need every bit of it, whether it's in chemicals, whether it's in AI, whether it's in electronics. So one is to bring in technology and really give them market access to the extent they want. And every M&A that comes from there into India, inward, is welcome, okay? Because they come in there, they make our things more efficient, they buy companies or they inject capital, and they make in India, for India, and for the world. So I think that is thesis number one, the one we have to blindly just go after. And I see the Ministry of Commerce and Industry really driving it, and along tangling with the Ministry of External Affairs. I think it's a great combo to approach these things in that manner. The second important thing is that our membership and other members as well of some other associations, they need to focus on enhancing our competitiveness locally. I mean, return on capital cannot be the only parameter that folks are focused on, return on invested capital. But what about investing more in R&D, in skilling? We need to up the game, right? Because otherwise, how are we going to become an alternate either to China or face the competition that comes from market access, which is definitely going to be lower, right? Whichever way you look at it. And the third thing is, the more you look at EU, the more you're going to push back. You're going to get pushback on sustainability, labor, other things. So we just have to, we as in India Inc., has to really up the game on the technology curve, on the innovation curve, and invest more from the income and balance sheet towards R&D and skilling. I think we have been comfortable for rather too long.
Yes.
We have used the tax breaks that this government gave a couple of years ago as a shield, not as a catalyst. And I think, it's going to take two hands to clap, right? So government is doing what they're doing, and they're probably, marching in a certain direction and pretty proactively. I think India needs to really buck up and, put a few extra dollars to work on a long, patient capital. Hope for returns come later. Otherwise, how are they going to be competitive?
Enhance that value-added proposition. Sanjay, noted. We're going to leave it there, sir. Thank you very much indeed for joining me with your insights. Sanjay Nair there, president of ASSOCHAM. I want to take the conversation now to the currency markets and bring you up to speed with China's onshore yuan, which has weakened to a new low of around 735.05 per dollar. That is the lowest since September 2023. This is important because this comes just before the imposition at around midnight US time of 104% tariffs, US tariffs on China. So perhaps this is the beginning of a broader aim by the leadership to depreciate and engineer depreciation in the yuan, in the currency, to help support the export side of the equation. But of course, eroding domestic purchasing power is the price they're going to have to pay. So it's always a double-edged sword. In the meantime, let's take a look at oil prices in early Asia trade, extending losses after a 4% drop in US trade overnight. WTI 57.68. We're now squarely below the 60 handle. Brent crude threatening to drop below that level. 61.02 is where we stand, down by almost 3%. We're back in 2 minutes.
CNBC. Live ambitiously.
Leaders of business and tech talk AI. Name another industry that has a $10 trillion total addressable market. That's why everybody should be excited.
There's an accessibility to generative AI. It's unlike any technology that we've seen.
And its impact on the way we'll live and work.
To make sure that we are skilling up everyone is something we owe to society.
It's not AI or people. It's AI with people. And that will cause an economic boom.
Highlights from Converge Live only on CNBC.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Welcome back. US President Donald Trump saying in a post on Truth Social overnight that he had a great call with South Korea's acting President Han Duck-soo, touting a potential great deal covering tariffs, shipbuilding, the Alaskan LNG pipeline, as well as military protection that the US provides. In the meantime, US-Japan trade talks are kicking off in D.C. CNBC's Kaori and Joji is tracking those talks and joins us now from Tokyo. Hi, Kaori, and what progress has been made?
Well, it's hard to tell from this vantage point because most of the discussions are going to be held in Washington, D.C., but I can tell you that in 40 minutes, these tariffs are going to kick in, and all of Japan Inc. is very, very nervous. There are call centers being set up across the country, and there have been ringing off the hook since Monday, particularly from the small and medium-sized enterprises that could get obliterated once these 24% tariffs kick in, not to mention the 25% on the autos and auto parts makers. So people are talking about recession. They've been talking about a slowdown in economic growth in the first quarter of this year, even before these measures took effect. So if we're talking about, say, minus 0.3% to minus 0.8% are the forecasts I've been seeing in terms of the impact on GDP, you're looking at a very, very precarious situation, Sri, for the Japanese economy.
Carrie, if there is any offset here, then you would imagine a greater commitment by Japan to buy more US LNG, and the conversation is similar and parallels that with the bilateral trade talks I'm sure are going on between India and the US. How much of a commitment and how big a role do you think energy will play in any deal that is cut?
I think energy is going to be a common denominator for many countries, and Japan, India, as you mentioned, particularly, and also South Korea. I mean, this interview with with Bessent overnight with CNBC was very, very telling. He dropped some major hints. Look what he said. There is talk of a big energy deal in Alaska where the Japanese will take a lot of the offtake and provide financing for the deal. I mean, it doesn't get more explicit than that. He's talking about a $44 billion natural gas project. Mitsubishi Corporation has expressed interest in the past to possibly up their investment in that stake. And as you know, this is a very fuel poor, energy poor country that needs it. And we have a president who doesn't believe in climate change. So I think LNG is particularly of interest, but there are other areas that they want as well. We've also heard the trade representative say that he wants more agriculture products into the Japanese market. They did a deal recently on beef. There isn't a whole lot of maneuver leeway, according to the economists I speak to, on the agriculture. But I think industrial products, motors and things that make energy, when you're trying to move that energy, could be on the cards. Because when you look line by line at the items that Japan imports to the United States, that comes up pretty high on top. I mean, cars are all the way down. It's virtually non-existent, Sri.
I'd imagine defence is up there as well. Carrie, thank you very much indeed for that. Let's turn to Southeast Asia, and Vietnam is another country scrambling to negotiate with Washington as duties of 46% are set to kick in at the top of the hour. Let's bring in JP Ong now into this conversation. What does Vietnam have to offer, JP?
So this is one of the bigger trade surplus against the United States. About top three, I think about 123 billion US dollars, Sri. And it seems that Vietnam is now sending their Deputy Prime Minister Ho Duc Phuc to meet with Treasury Secretary Scott Bessent actually in the United States at 4 p.m. Eastern time, which will be way after the implementation of some of these tariffs. Now, addressing and trying to mitigate this trade surplus will be a tall task for Vietnam, but they have actually identified one area that might be of interest actually on both an economic and geopolitical reasons that is, and that is increasing defense products and defense spending and buying more American defense products actually to help mitigate this. Now, as we know, the history of Vietnam and the United States is quite checkered because they did go into the Vietnam War about 60 years ago, but this time around it seems there is an opportunity for American defense goods to actually come into the Vietnamese markets and actually supplement the Vietnamese military. We have to remember that Vietnam generally sources a lot of their defense products from three particular countries: Russia, Ukraine, and Israel. What these three countries have in common is that they're all embroiled in conflicts, and we've actually seen exports to Vietnam of these goods from these three countries drop to about zero over the last 2 years for many reasons that perhaps aren't surprising. Now, this creates an opportunity for U.S. companies to actually come in, defense companies, to supply them with guns, to supply them, for instance, with other arms, tanks, and the like, apart from Coast Guard vessels. And of course, as we know, Vietnam also needs to upgrade their military and make sure that they have a tremendous significant source. But this also runs a couple of risks, Sri. On one hand, you do have the switching costs because, again, switching from Russian to American systems, there are some switching costs and retraining costs that need to be accounted for. The second thing also is what China might make of Vietnam and other Southeast Asian countries upping or increasing their acquisition of U.S. military goods also. So again, there are a few things they'll have to finesse also. It's not going to be straightforward. And again, the question is, will this be enough actually to address that massive trade surplus that Vietnam has?
Well, things for sure. We're seeing an arms race in earnest in this part of the world, if not elsewhere. JP, thank you very much indeed for that. Coming up next, one of India's fastest growing airlines, Indigo, has got big expansion plans, but could US tariffs ground those ambitions? We'll hear from the company's CEO. Peter Elbers will be joining us in a few moments' time. Do stay tuned for that conversation.
the age of digital disruption. Get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. cnbc.com/technology.
I'm gonna show you the way Vietnamese people enjoy coffee in the morning. I live here and I have to say that I love the traffic here, which seems like chaos to foreigners, but it's actually an organized chaos. Everything works. Xin chào! Hello, my name is Khánh Vi. I'm a content creator and a TV host from Vietnam. Here we are at District 1, which is the central of Ho Chi Minh City. I think this is one of my favorite spots in the Independence Palace. This is the way of selfie for Gen Zs, 0.5. I'm originally from the north central province of Nghệ An, but I've stayed in Ho Chi Minh City for a couple of years now. Ho Chi Minh City has such great energy, and you can feel that when you come here. Nguyễn Huệ Boulevard, and I'm so excited to bring you around our largest city in Vietnam. And here's what I do in my downtime.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better, and not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
Brian Sullivan joins Kelly Evans, Power Lunch, CNBC.
Welcome back. We are counting down to the market open in India, and this is how we are shaping up. We are looking at some weakness. 22,427 is where we are expected to kick off. So we are looking at about 100 or 200 points off a decline. Nothing disastrous, but the story really is about 104% US tariffs on China goods that are going to be kicking in at midnight US time. And of course, for China's manufacturing rivals like India, that of course increases the tariff differential, arguably in India's favor. So that is the offset in terms of the overall picture. But let's wait and see what this global market volatility does, and whether it sinks all the boats in the harbor, which seems to be the narrative at the moment. In the meantime, shares of Interglobe, parent of Indigo airline, recovering, as you can see there, from the market fall on Monday to soar to a record high on Tuesday. And in the last 2 months, you can see that the stock has been up nearly 20% after Indigo's bullish outlook last month to increase its share of international capacity to 40% by 2030 from the current 28%. Indigo is already a major player in its domestic market with a 60% share and commands nearly 20% of India's international flight market, flying to 40 destinations worldwide. Last month, it also entered the European long-haul market with non-stop flights to Manchester and Amsterdam, and it's planning to increase its fleet to over 600 within the decade. It will include leasing Boeing Dreamliner jets. Big question now, how much will Trump's tariffs change all of that? Let's put that question now to Peter Elbers, CEO of Indigo. Peter, great to have you on the program. So all-time high on Tuesday for Interglobe, which operates Indigo. So the market at least believes that Indigo is well positioned to ride out this uncertainty. What's the stock price telling you, and how much conviction do you have in the outlook?
You know, at Indigo, and good morning, and thanks for having me with you. At Indigo, we're in fact a very much part of the India growth story. And Indigo has developed in the past 18 years from a very domestic-oriented, low-cost airline into basically the market leader in India itself, and increasingly international. And the potential of India with the economic growth and the growing middle class is enormous. And I guess that's been reflected in the appreciation of that stock price indeed.
What are the odds Peter, of a global trade war and a global recession, and how is this going to impact travel demand for business and leisure within India and inbound and outbound?
You know, when we look to India, and India it's on its way to become the third largest economy in the world, the penetration of air travel is still very, very low. And if you compare it to Europe or for that matter to China, the air travel penetration is low and the need for mobility, both domestic and international, is high. So the combination of a growth of economy, a growing middle class, a young population, coupled with a low penetration today in terms of air travel, makes the outlook for us very bullish. And we've set a path to double by the end of the decade. And basically we've announced that strategy 2 years back, and we're well on the way in achieving those numbers.
Understood. Peter, where are you putting passenger load factors within, let's say, a 3 to 6 month time frame?
You know, the Indian market is very late booking market, and from that angle, giving any load factor predictions for the next 6 months is I guess just a wild guess. I think what is important for us is what we have seen actually, even with some of the sort of outside dynamics and global dynamics, that the demand in India and the domestic demand in India and the Indians going abroad actually has been so far unaffected by these elements. We've seen healthy loads, we've seen good development, you've seen our earnings for the third quarter, which were positive. So from that angle, actually we see a continued outlook as we have seen over the past quarters.
Peter, you're painting a very bullish picture about the demand prospects in India, but can we say the same about international markets? And where then is that putting your plans for a fleet expansion? Are you having any second thoughts about where you're going on that score? Or again, is it business as usual?
I would say the latter. It is business as usual. And we're thriving on two factors. One is the increasing demand from India itself for going international, and perhaps traditionally that was very much oriented from India to the Middle East. Nowadays, and especially looking at the geographical position of India, where 65% of the world population is living within 5 to 6 hours flying range of India itself. So we're not only benefiting from the Indian market, but also from a huge opportunity to connect over India for international markets. And from that perspective, India was lacking a global hub position and clearly has the ambition to become one. So that combination of a strong, growing domestic and increasingly international market and the opportunity to connect gives us a lot of confidence in our plans for further internationalization.
Understood. Peter, what does the aircraft order book from Boeing look like? And how confident are you that suppliers can fulfill those obligations if there are possibly manufacturing supply chain issues that are arising because of tariffs?
Yeah. Well, we are I would say 98% Airbus operator. We have a couple of damp leases in Boeing, and for the rest we're Airbus operator. We have a massive order book, probably the world's largest order book, with over 900 aircraft yet to be delivered. And these 900 aircraft are coming in pretty much in the phasing of one aircraft every week. This financial year, which started on April 1st, we are entering the Airbus XLR into our fleet that will further expand the range of doing. We've ordered the 350s coming in 27, and in order to bridge between today and 27, we have taken some 787s on lease from Norse in order to prepare for that further long-haul expansion we're doing.
Peter, and so far, the word from Airbus, no cancellations, no delays, everything is on schedule?
Yeah, I mean, there's always, I would say, a natural tension globally when it comes to supply chain challenges, and Indigo is not excluded from those global challenges. But over the past 2 years, I think Indigo has demonstrated very well to be able to have a whole range of mitigating measures and to live up to our capacity guidance. We closed last calendar year with 113 million customers, and that's up from 78, which was there prior to COVID. So I think that entire ambition to continue to grow has been materialized despite some of the global supply chain challenges.
Peter, are you factoring factoring in a lower price outlook for jet fuel? And if so, where does this leave the pricing environment for airfares?
You know, the fuel price, I guess, is a factor where, you know, we just have to deal with. And in the long range, there's always a reflection in airfare tickets as related to fuel prices. I think what's very important for us is that we maintain our cost leadership. Indigo has a fantastic track record when it comes to a cost leadership with that dimension. Of course, we'll deal with the fuel price. We also have the lowest, or actually I should say the youngest fleet, lowest emission fleet for all airlines larger than 100 aircraft. For 3 consecutive years, we're in that league of having the youngest fleet. I think those elements are helping us a lot in order to maintain that cost leadership despite some of the variations in fuel prices.
Got it. And Peter, there's no reconsidering at this point the major push that's underway at Indigo into cargo, given the global economic uncertainty, or are target markets like Saudi, GCC looking resilient regardless?
No, not at all. I think we have a long-term view at Indigo. The Indian air travel market has been underserved and underpenetrated for a long time, and as we call it, this is India's time, and India's in a hurry, and so is Indigo. So our ambition to take part of that pie, where a lot of cargo today is being shipped in and out of India with non-Indian operators, I think gives us a great opportunity to take some of that market share. And a lot of initiatives are taken in India to develop more manufacturing next to the services industry. And I think that's a very promising sector for India, and hence we're taking big steps also on the cargo side.
Got it. And how are you positioning, whether it's cargo or commercial, the airline to capture the India GCC corridor, which is flourishing?
Yeah, well, I think there we are very well positioned. We operate over 200 flights a week between India and the UAE. We fly actually dozens of different routes from different points in India to different points in the UAE. That percentage will continue to grow going forward. So we're actually very optimistic on that part. That was the first part where Indigo moved international. I think today we have developed a very solid position there, but we've recently added flights into Central Asia, Africa, Indonesia. So really connecting those flows over different points. And there we really see that the effect even of connecting flows are helping a lot.
Peter, great conversation. We'll leave it there, sir. Thank you very much indeed for joining us on Inside India. Peter Elbers there, CEO of Indigo. Thank you. Right, counting down to the market open in Mumbai. We are back in 2 minutes.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about is automation of tasks.
You're going to feel like they were just always part of your life.
We'll give you examples and how you can use AI tools at work and in life.
Register at cnbcmakeit.com/AI.
The age of AI is now.
My mentor always told me that your career is going to be a marathon, not a race. Often, you're not the only one running, so learn from those in front, support those behind, and when it counts, win well and lose well.
This is CNBC On Assignment at L'Oréal's US Research and Innovation Center.
Pledge is to invent the future of beauty, and therefore to do that you need the future of research centers, and that's exactly what's being built here, potentially the blueprint for our future R&D centers around the world. And it's going to serve the USA, our #1 market, but not only, because here will be invented new formulas that will serve consumers all around the world.
With a competitive beauty market constantly evolving, innovation is crucial to stay ahead. Consumers now seek products that cater to their unique skin tones, textures, and concerns rather than one-size-fits-all solutions.
Personalization is definitely the future of beauty. Real personalization is also what I would call the ideal curation, is giving you the most precise recommendation of existing products, but which combination will be perfectly matching your needs, your skin tone, or your hair type.
Welcome back. We're watching the Indian rupee ahead of the RBI decision today. This is where we stand, and the rupee under some pressure against the US dollar at 86.5570. CNBC TV 18's Ritu Singh has a preview of what to expect.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC TV 18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC TV 18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is, what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs, but for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
Thank you for that, Ritu. And Indian markets are just joining the trading day, and they are looking softer. Nifty 50 off by about 0.7%. It did kick off down about 0.3%, but it is gathering some negative momentum. And that may be because the pharma index is down quite heavily in terms of the sector level action after President Trump reiterated tariffs on pharma imports. The IT index also down quite heavily at a sector level by more than 1%. The saving grace, of course, could be the RBI, and a willingness and an intention to do more beyond the 25 basis point rate cut, which is expected in the repo rate. Let's bring in Sonal Varma now, Chief Economist, India and Asia, ex-Japan at Nomura. Sonal, great to have you on the program. Will the RBI revise the growth forecast lower? I know that Nomura as a house has done, and what can we expect?
Well, they definitely should be revising the forecast down. RBI is currently expecting growth to actually accelerate in the ongoing financial year to 6.7 from last year's 6.5. But the incremental developments, particularly in the last 1 week, the tariff shock and its impact both directly on India but indirectly through the weaker global demand and uncertainty channel clearly means the 6.7% looks quite optimistic. Our own view is RBI is likely to cut the numbers probably down to around 6.5%, which in our view is still too optimistic. We think growth will be closer to 6%.
I understand. The outlier is front-loading 50 basis point cut at this meeting, Sonal. Is that going to happen, or would that panic the market?
I think it'll be probably seen as a panic signal. Now, just to be clear, at 6 quarter, which is where the repo rate is, we are, in our estimate, 75 basis point above neutral. So you could argue that there is a case to be made that there's room. Why not just front load it? So it's, one of the policy options. But as you said, I think from a signaling perspective, given we are still very early in terms of determining what the exact impact will be, And India, in the relative scheme of things within Asia, is one of the least exposed from higher tariffs. So I think the panic signal from a 50 basis point probably is too much. So a 25 with potentially an accommodative stance should do the job.
Understood. And Sonal, what then are you pricing in terms of a dovish outlook and dovish signalling by the RBI? Are we talking about cumulatively 50, if not 75 basis points in cuts over the course of 2025?
Yes, that is our view. So we are expecting back-to-back rate cuts in the next three meetings, so 75 basis point in total. And alongside this, the liquidity side, which is quite important for policy transmission in India, RBI has been fairly aggressive and banking system liquidity has moved into a surplus. A commitment from them today in terms of keeping banking system liquidity in a sustained surplus going forward would be an important positive signal that will reinforce policy transmission and enable banks to actually cut policy rates, the lending rates even further. So the liquidity signaling is something the RBI could do as well today. And I think the, things are extremely uncertain. But we know that there are downside risks both to growth as well as to inflation given the big drop in oil prices, and therefore the communication and the forward guidance that the RBI remains open to doing whatever it takes to support growth while ensuring stability. That messaging will be important.
Sonal, how material or marginal could a BTA, a US-India bilateral trade agreement be if it is struck, if it is if it does materialize?
It could be material. So the broader framework of the bilateral trade agreement in terms of tariff, non-tariff barriers, giving more market access for U.S. firms, and also cooperating on longer-term supply chain partnership resilience. The contours of this agreement have been finalized. Now, the negotiations will take time. From India's side, it does appear that the government is open to reducing tariffs on a number of products and potentially increasing market access, buying more of U.S. products, which is one part of the deal. The expected timelines on this, though, is a bit far out. So around September, October is when the first phase of the trade agreement could be signed. Now, there are two potential benefits to India from here. One is the existing reciprocal tariff rate of 26%. If it is brought down slightly, would still give India an edge on a relative basis, particularly compared to the competitor export nations, which is Southeast Asia and China. And second, I think the partnership on supply chain over the medium term is important because India is looking to benefit from the supply chains that are moving from China.
Understood. And just to be clear, how likely is it, Sonal, that RBI will change its stance to accommodative from neutral currently, and that will give us some insight into where they are in terms of directionally easing and more rate cuts?
It is a coin toss, but I would say, it's at the end of the day more of a signaling device. At the end of the day, we know that there are further rate cuts on the cards because inflation is at target and output gap is actually looking like it is going to be negative. And through the aggressive liquidity easing and moving banking system liquidity into a surplus, the RBI has already shown its hands and actually signaled that they are accommodative. So the official change in stance from neutral to accommodative would be a stronger signal. But even if, let's say, they stick to the neutral stance, the forward trajectory in terms of both the rate cuts and liquidity easing will still remain the same.
Sonal, in a global environment where there is a non-trivial risk of stagflation, where are you putting the inflation outlook for India domestically? And I suppose what works in India's favour is oil prices are coming down significantly, but we have the vagaries of the monsoon, we have the vagaries of agricultural production, and of course the consumer seems to be somewhat stressed with relatively high levels of household debt as well. Where does that put inflation on a 6 to 12 month horizon?
On our forecast, inflation should average close to the RBI's target of 4% in the next 6 to 12 months. In fact, we could have the next 6 to 9 months of inflation actually undershooting the midpoint of the target, so more in the 3.5% to 4% range. As you said, food prices remain a risk. If it's a heat wave, then perishable prices could pick up. But the more sustained drivers of or the sticky components of food inflation, the outlook there looks positive. Wheat output has been higher, and the expectation is this year's monsoon season will be normal. Importantly, I think given the demand hit that India is seeing and the negative output gap, plus the risk of some redirection of the excess capacity in China
Yes.
or elsewhere in the region, I think disinflationary forces actually look more likely than inflationary force. So we are not that worried about inflation.
Sonal, do you feel that big MNCs like Apple, given the tensions and global trade landscape, could double down on India as a manufacturing hub? And where then is there upside to FDI on a 6 to 12 month basis?
Yeah, we do think India is going to be one of the biggest beneficiary of the ongoing and the next round of supply chain shifts. Now, FDI in the current global environment we are in, typically there is a pullback of all kinds of investment, whether portfolio or direct. So it might take time for FDI to come in. May not necessarily be a 6 to 12 month story, more of a 2-3 year kind of a story. But I think there are two aspects for India which should be favorable. One is the reciprocal or the aggregate tariff rate differential between India and China or Vietnam is in favor of India. And yes. Therefore, in the short term, it does make sense for a lot of the MNCs to divert some of their production from China, Southeast Asia into India, where the tariff rates relatively are lower, and there is scope to lower the tariff rates further. But second, from a medium-term perspective, a more strategic shift in these manufacturing facilities into India we think is likely because India is a strategic ally of the U.S. It is working with the U.S. on more longer-term partnership, and the government is also quite keen in terms of the subsidies that are coming through to the production-linked incentive scheme. So we
Yes.
do see benefits both near-term and medium-term.
Sonal, thank you very much indeed for those insights. Sonal there from Nomura. That wraps it up for this edition of Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.
CNBC. Live ambitiously. Squawk on the Street. CNBC.
Check your wardrobe and you'll realize that today, most of your clothes contain synthetic material, and that's mostly polyester or plastic.
Between 22 and 23, manufacturing of textile fibers in the world grew from 116 to 124 million tons. All of that growth was from polyester. Now, the problem with polyester is not going to disappear.
But what if there was a way to break down these fibers and recycle polyester into new clothing infinitely? To reach this goal, French engineering group Technip Energies collaborated with American business tech leader IBM.
We have been concerned about circularity in the carbon economy for a long time.
Reju is aiming at building a complete ecosystem to tackle the challenge of textile-to-textile recycling.
We could potentially not need to take any new raw materials out of the ground to make polyester.
Sponsored by...
If you're really ambitious, you don't think about the end goal. You're too busy thinking about the process of getting there and the growth that you need to achieve. And nothing can beat that.
So this is the best dish to me in Vietnam. Good. Childhood flavor.
Hi everyone, my name is Thủy Tiên and welcome to Ho Chi Minh City. Lotto is the name of the game, just like bingo in America.
Vietnamese people drink coffee every day. If you drink the Vietnamese coffee, you can recognize the difference in the Vietnamese Robusta beans. It's a very strong, very resilient beans. Bitter.
I think it's quite hard to the foreigners to imagine what they have in Cơm Tấm. You can find a lot of different kind of seafood here because we have a long oyster. It's like the time when you feasting and socializing with your friends and family. 1, 2, 3, go! Join me during my downtime.
Good morning. We begin with breaking news this hour. The latest American tariffs on global trade are now in effect. 10% on all trading partners and a higher rate on 86 other nations, including that 104% tariff on Chinese goods. Live right now to the Asia markets for a check on how we are seeing regional investors respond here. And of course, we have seen markets move lower in tandem with US equity futures and of course, Wall Street as well, as investors brace for another round of volatility here as we track into the open of trade stateside. Japan's Nikkei 225 among the loss leaders right now, down by 3.67%. The TAIEX down 4.7%. Hong Kong's Hang Seng off by 1.55%. But you can see markets on the mainland are holding on to gains up by just 0.24%. US equity futures also pulling lower right here, right now as well. And as I flagged for you, it was a down session on Wall Street. Losses expected to continue when trading gets back underway. The Dow off by almost 700 points. It was another remarkable session on Wall Street. Markets surging around 4% higher after the open, but closed lower across all of the major averages. It's the first time since the 2008 global financial crisis that the US market erased a similar session gain. And take a look at this, more red flags. Wall Street's fear gauge, the VIX, hitting the highest level since the start of the pandemic, now tracking at 52.33. The US dollar also weakening alongside prospects for the US economy. Right now, dollar index is looking like this. You can see tracking at 102.46, and that of course has ripple effects, wider consequences across the FX landscape. Risk assets looking like this. Gold has been moving up as investors fly to safety. Bitcoin also pulling down here. And oil down significantly overnight. We're going to be talking more about that shortly. But let's begin with this breaking news, the most punitive tariff of them all. It's China's fresh 104%, also now in place. Emily Tan is the host of CNBC's The China Connection. She joins us live now. Emily, walk us through this, the brinkmanship obviously continuing here.
Yeah, we are tracking the latest development here, Dan, and we just heard from President Trump just a short few hours ago when he was speaking at the Republican and National Convention event, stateside, Congressional Committee, and he was talking about everything from China, the Trump tariffs, to TSMC and the risk of 100% tariffs if the company did not continue to build out over in the United States. Trump has accused China of manipulating its currency as well, and he also thinks that they could be making a deal at some point, and that is weighing on the market. Pull up the Chinese markets, pull up the Hong Kong market. We did see a spot of green when it came to Shanghai. Now, I have to remind you that the national team is on alert, and so, of course, it is supporting the market today. Shanghai Composite better for 0.25%, Shenzhen higher by 0.5%, and the CSI 300 higher by 0.3%. The market is in the lunch break now, so no trades at the moment. We're also scanning what's happening in Hong Kong, and it is a further downside that is playing out here off 1.5%. We are keeping track of some of those trade proxies, names like Tektronix, which is the power tools maker, as it's sold in Home Depot. Lenovo, the world's #1 PC maker. We got Yuyun Industrial, which makes the shoes for Nike as well as Adidas. Before I send things back down, let's listen in on what President Trump had to say earlier a few hours ago.
And after all of the abuses they've perpetrated, China's attempting to impose additional unjustified tariffs. Just so you understand, they all got rich because of tariffs. That's why additional tariffs on Chinese goods are in place effective midnight tonight at 104%. They want to make a deal. They really do. They want to make a deal. They just don't know how to get it started.
So he thinks that China wants to make a deal, and China on their part says they're going to be fighting till the end. Dan.
And we'll have to see exactly what happens next here. But the United States also taking aim at the Chinese currency as well. What can you tell us about that?
Yeah, this is a managed currency, and what that means is the PBOC, as we know, they issue the reference rate every morning at about 9:15 Hong Kong time, and then it starts trading at 9:30, coinciding with the Hong Kong market open. And now, the offshore yuan was traded at its weakest level since records took place, and we are looking at the CNY. That was priced earlier this morning. We're looking at 7.2066, and the CNY is currently traded at 7.3497. The offshore in Hong Kong at 7.385. Traders are saying that they are expecting the pace of depreciation to accelerate, with potentially China hinting at greater flexibility for the currency. It's allowed to trade within a very tight band after the pricing or the fixing every morning. There has been some suggestions that would be one way that China can counter the tariff impact is for a major depreciation in the Chinese currency. We're seeing it at about 7.3 right now. Some have called for 7.5 by the end of this year. President Trump, on his part, has accused China of manipulating the currency to offset the impact of the tariff. So we are tracking the currency, the CNY, last traded at 7.3497. Dan.
Okay, Emily, thank you. I also want to flag what's happening with the Japanese markets now. You can see the Nikkei falling after yesterday's rebound as the Japanese delegation also gets fast-tracked into tariff negotiations. Kari Onjoji is live again for us today in Tokyo with the latest. She's following these talks and the market declines. Kari, hello to you. Just walk us through what you're seeing right now.
Hi, Dan. Well, the Japanese government is hoping that first mover advantage has count for something, but we have a pretty good idea, at least on the surface, of what the U.S. side is going to be looking at in these negotiations. So let's take a listen to one comment from Scott Bessent, who will be leading part of the talks with the Japanese side.
Look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
It's very telling that he put the military component of the Japan-U.S. Relationship together with the economic part, because they are part and parcel and they go hand in hand. I mean, to make a dent in the trade deficit, people are talking about more defense spending, which has historically been about 1% of overall spending here in Japan, but that's being gradually increased to about 2%, but that is not enough, according to Donald Trump. So they could be buying some more military hardware. I mean, the markets, I'm going to stay away from that because the markets here are just not behaving as a mature market anymore. This reminds me of a market reaction in an emerging economy. But I do want to highlight one part of the market, which is the bond market. Look at the yield on the long bond today, the 30-year long bond. The yield on that is hitting its highest level in 20 years and 8 months. I think this is a significant move because it factors in the expectation that the Japanese government, it might have to abandon its fiscal program. In other words, additional stimulus, and that's going to put pressure on its fiscal condition. So I think that's how the bond market is reacting here. So as we pointed out, Dan, yesterday, this is going to be a package deal that Japan wants to negotiate, not only with the U.S., but to try and come up with something that's going to help these small and medium-sized enterprises at a time when everyone is fearful that Japan may slip back into recession fairly quickly if these tariffs continue as they are.
Excellent point, Kari. And we are seeing the 30-year JGB at its highest level since August of 2004 now. We appreciate your reporting. Thanks again for joining us. Meanwhile, U.S. yields also moving higher here as the market digests this trade uncertainty. Take a look at the long end of the Treasury curve right here, right now as well. You can see the 30-year at 4.98%. At the short end, the 2-year 3.76 and the 10-year yielding 4.48%. So we're seeing investors attempting a flight to safety here, perhaps seeking some shelter in the Treasury market. We'll continue to follow that for you. Meanwhile, the U.S. Energy Secretary Chris Wright spoke to our U.S. colleagues about the potential for tariff negotiation, as well as the upcoming Iran talks set for this weekend. Listen in.
I've had all sorts of outreaches from countries in Asia, in Europe, and elsewhere that are very interested in buying more American energy. Natural gas today is the second largest export in the United States, and it's the fastest growing export in the United States. So absolutely, growing United States energy exports to Europe and Asia and our allies around the world, good for America, good for our allies. Look, I'm not celebrating the deindustrialization of Europe. I'd love them to reinvigorate and lower their cost of energy and grow their economies as well. We're for economic growth around the world, but certainly led by the United States.
And then what about Iran? Wanted to get you on the record on that one too, because there's an important meeting on Iran nuclear program coming up this weekend. First of all, what are your expectations as far as those sanctions that are in place? And is there a scenario where if they don't make a deal, you will become a tougher enforcer on those energy sanctions to limit their flow of oil?
Absolutely. I mean, that's what happened in the first Trump administration, right? People thought you can't really sanction Iran. Of course you can. And in the first Trump administration, Iranian exports of oil plummeted. Therefore, the money they had to fund terrorists shrunk dramatically, and Iran was less of a troublemaker in our world. They were allowed, that sanctions didn't get removed, but they just stopped enforcing them during the Biden administration. Their oil exports surged, their money from that revenue surged, and the trouble they've caused, you know, from Hezbollah to Hamas to the Houthis, all of these are Iranian-supported groups. And with American energy production, strong American energy production we have today, we have tremendous leverage with Iran. So absolutely, I would expect very tight sanctions on Iran and hopefully drive them to abandon their nuclear program. That's the only way everyone in the world is going to sleep better at night. We cannot have Iran with nuclear weapons.
Let's mark what's happening in the oil markets right now as well. You can see prices under pressure here overnight and also continuing to fall in Asia, with WTI now sub $60 a barrel, actually heading towards 55. You can see tracking at around $57 a barrel, but both contracts falling 4% as this China tariff kicks in. Of course, it is not just the tariff risk and the recession headwinds impacting the oil market. It's also increased OPEC supply, with additional barrels coming onto the market this month and, of course, possibly next month as well, meaning that additional supply will also pressure prices moving forward if we don't see demand demand improve. So this will have wider consequences for the Gulf. And of course, we're going to talk more about this tariff impact and what's happening in the oil markets, plus the translation for the GCC. Farouk Sousa is here. He's Middle East and North Africa economist at Goldman Sachs. Who better to weigh in on what we're seeing unfold right now globally and in the region? Because, Farouk, this 104% US tariffs on Chinese goods is not just a US-China story. It's a global demand shock. It's also going to prompt what could be a very significant supply chain alignment as well. So give me your headline take on this. What is it going to mean for Chinese capital flows and, most importantly, broadly for the GCC?
Yeah, I think, the most obvious impact of everything that's happening on the GCC is the drop in oil prices that you've been highlighting at $60 a barrel. The deficits on the fiscal side that we're likely to see in the GCC countries, especially big countries like Saudi Arabia, are going to be pretty significant. That means more borrowing. It probably means more cutback on expenditure. It probably means more selling of assets, all of the above. And this is going to have an impact both on domestic financial conditions and potentially even international.
Goldman has already revised down its oil price forecast for 25 and for 26. Can you give me any insights on what this latest fall means for that new outlook moving forward? And more broadly, how vulnerable are GCC fiscal positions as we see oil prices sink towards $55 a barrel? I flagged this earlier, but we haven't seen this since March of 2021.
Yeah, we revised our oil forecast down on a number of factors. Most importantly, the cuts to U.S. growth that we're seeing in our forecasts, the increased likelihood of a recession, which we've raised to 45% in the United States. All of these things weigh on our concerns around global demand. The latest tariffs being introduced on China are not going to help in that regard. But as you said in the lead up to this, there are other factors, including the shift in OPEC plus reaction function, which is leading to greater supply in the international market just at the time when concerns around demand are peaking. So that is not helping. And I would say also that the bearish, there's more bearish tailwinds coming from, or headwinds coming from the Iran talks this weekend. So, I mean, altogether, the outlook is looking pretty soft. The impact on the GCC from the fiscal side could be significant. Let me just give you one example. In Saudi Arabia, we estimate that we're probably going to see the deficit go up from around 30 to 35 billion to around 70 to 75 billion if oil prices stay at around $62 this year. 70 to 75 billion, that's a large number. Financing that international markets, particularly given the difference that international markets are going through right now, is going to be challenging. That probably means that we're going to have to see some alternative actions taken by the Saudi authority to bridge that funding gap that they're facing this year.
Expand on the impact in Saudi Arabia for me, because we have been speaking with policymakers over the last year who have suggested to me that some cracks are already starting to emerge in the Saudi fiscal story, and whether or not the government actually has the fiscal headroom to address this and also the ability to raise capital in order to fix that budget gap is a big question now.
Yeah, I mean, on paper, the Saudis have a debt to GDP ratio that is below 30%. So yes, they have a huge amount of fiscal headroom to go out and borrow. They would borrow another 10, 20, 30% of their GDP, which is, close to 200 billion. That really wouldn't have a big impact on their overall debt dynamics. But of course, borrowing that amount in the markets is a very difficult thing to do. So like I said, if we're looking at a $75 billion funding requirement this year, can Saudi Arabia come out to the markets and just issue $75 billion worth of debt? It's probably unlikely, given that there's a limit to how much the markets can absorb. So that debt to GDP ratio, while comforting, doesn't mean that, the Saudis can issue as much debt as they like. They're going to remain price sensitive, and that's going to limit how much debt they can issue. So they do have to look at other remedies. One of those remedies is pulling back on expenditure. Another is raising taxes. A third is to sell more of their domestic assets, and that could be the local companies that the Saudis own, including Saudi Aramco and all those kind of companies. And then the fourth is to sell their international assets, which is also an option. So the Saudis have lots of options. The mix of all of these is very difficult to prejudge, but certainly we're not looking at some sort of crisis. It's just a question of which options they go for in order to deal with the challenges that they're facing.
Fair point. And at the same time, all of this coming as global investors also look at the inflation translation. It means that Gulf central banks are going to have to watch out for imported inflation as well. That will have significant consequences given the currency peg and the fact that a lot of these GCC economies have to move in lockstep with the Fed. So what's the inflation translation for it?
Well, I think the primary channel is through the FX. As you said, if we see a continuation of weakening dollar, clearly that is inflationary for the GCC countries. But the central banks in the region don't have any autonomy over monetary policy. They're going to have to move in lockstep with the Fed. So we're going to have to look out for non-interest rate type controls, including adjustments in the reserve requirements and so on. But I'd say just on the inflation front, that the dynamics are, number one, relatively benign in the GCC at the moment and have been to date. But there is a concern around certain pockets of inflation, particularly in Saudi Arabia. We're seeing very strong housing inflation. And this is related to the very strong growth in the non-oil sector that we're seeing in Saudi and the huge inflow of human capital in Saudi. It's very hard to find an apartment in Riyadh at the moment. The prices are very high. So there are bottlenecks that have appeared associated with this very, very rapid investment and very rapid growth in the non-oil sector that are inflationary, that have nothing to do with the external environment.
Indeed. Okay, Farouk, so let me just get you on a couple of really important points here. Regional growth forecasts, particularly for non-oil GDP. Will Goldman downgrade?
Well, I can't say for sure. I think it depends on the reaction function. If we see a big pullback in projects and in government spending, then certainly that's going to be negative for growth. However, if we continue to see expenditure financed by debt issuance or by the sale of assets, then that should have no growth impact whatsoever. And the other thing that you have to bear in mind is that when we're thinking about growth overall, we are also taking into account production of oil. And production of oil, as we highlighted, is going up. So the overall headline number is going up. As far as the non-oil growth is concerned, we'll have to wait and see how the governments react.
I know your energy team is probably crunching the numbers as we speak, but how much lower do you think oil goes from here? And will Goldman also issue a new forecast on what that number is going to look like?
I can't speak to whether we're going to issue a new forecast or not ahead of time, but what I can say is that the risks are certainly skewed to the downside. But for the time being, we've taken into account some pretty drastic downgrades to our U.S. growth outlook and taken into account what we think is the likely path for the supply as well. So we're probably pretty comfortable, but prices are going lower. Our forecast for next year is $58 a barrel for Brent on average. So that implies a further sort of 6-7% down on where we expect oil to be this year.
Indeed. Okay, so just finally here, what does this perhaps revised oil outlook, if we do see oil prices move lower from here, what does that mean for regional investment trends as well and the investment narrative in this part of the world? Are we going to see a cooling of the diversification momentum that we've seen over the last couple of years? Or are we going to see governments react in a way that accelerates this because they are going to be under increased pressure as a result of lower oil prices and, of course, higher tariffs, which are fanning recession headwinds? What happens to the investment space as a result of these new tariffs and the situation that we see macroeconomically globally right now?
I think that's the question, right? I mean, there's two ways that the governments can go about dealing with this terms of trade shock that they've received, this reduced oil price and lower oil revenues. Number one is to carry on as before, pushing ahead the investments and just borrowing more and selling more assets in order to finance that, rather than relying purely on oil revenues. And the second is to pull back on these investments and try and borrow less and preserve more of their assets for the future. Where we end up on that is anyone's guess. I imagine it's going to be a combination of both. There are some investment projects that are pretty much non-negotiable. They have to go ahead. If we think about things like the World Cup in Saudi Arabia, Expo, some of these projects are very mature, well past the halfway mark in terms of implementation. Those also will go ahead. But there is scope around the edges, and this is something that the Saudis and others have been doing for a number of months now, which is to reprioritize, rephase some of these projects. We think about NEOM, we think about some of the other projects in Saudi Arabia. Those have already been subjected to reprioritization and rephasing, as we know, and that's probably going to accelerate. Now, whether or not that has a big impact on growth domestically remains to be seen, because, in my opinion, the implementation of all these projects all at the same time was probably unlikely anyway, and probably going to lead to some sort of overheating. So, in my opinion, pulling back from these projects is not necessarily even a bad thing from a growth perspective.
Indeed, and the consequence is also real for the emerging market economies in North Africa and across the wider region as well. We've spent a lot of time talking about, of course, the big economies here, Saudi Arabia, the UAE, but the real impact is going to be felt on the ground in those smaller economies as well. Farouk, we'll save the conversation for next time. Thank you so much for joining in today. Really appreciate you joining us here on Access Middle East. That is Farouk Sousa from Goldman Sachs. And as we track into a break, we'll leave you with a live look now at the Asia market picture as Japan's Nikkei 225 extends its losses. Stay with us. You're live on CNBC. We're back in 2 minutes.
CNBC has the most affluent audience in television, and my job is to tell viewers how the wealthy make it, spend it, and give it away. I grew up in upstate New York. Both my parents were artists, so we didn't have money, but they taught me to appreciate beauty and also see things a little bit differently. For a lot of people, their ambition is to get wealthy, but money itself doesn't have any meaning. It's how you make it and what you do with it that gives it purpose.
Good money.
Everything will seem legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fought for them.
I believe in getting justice.
American Greed on CNBC.
Real money, real debate, real-time moves. Scott Wapner, live from the New York Stock Exchange. Halftime report, CNBC.
Welcome back to Access Middle East. Your news update now, and 2 Chinese nationals have been captured fighting for Russia in eastern Ukraine. China is a close Russian ally, but it has not been publicly known to have been helping Moscow in Ukraine. In a statement on X, the Ukrainian President Zelensky claimed they have evidence suggesting many more Chinese citizens are fighting, but did not indicate if they were doing so under Beijing's orders. The Ukrainian foreign minister has demanded a response from China. Meanwhile, people taking to the streets in Panama City protesting U.S. Defense Secretary Pete Hegseth's visit. Hegseth is in town to check out the Panama Canal as President Trump insists on taking back control of the canal from so-called Chinese influence. And President Trump saying in a post on Truth Social overnight that he had a, quote, great call with South Korea's acting president Han Duck-soo, touting a potential great deal covering tariffs, shipbuilding, the LNG pipeline, as well as the military protection that the U.S. provides. This is the latest in what Trump says is a long line of countries willing to talk trade.
In addition, we have a lot of countries coming to see us that want to make a deal, and we're doing We're doing things that nobody's ever even thought about doing.
On the other side of this break, we will continue to track the tariff impact, but we're also talking crypto as prices remain under pressure. Stay with us. Access Middle East, back in 2 minutes.
The power plays are here, breaking down markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
I've always had an ambition to do something I loved. I actually got my degree in hotel and restaurant management, but I had a thing for numbers, and that's how I got onto Wall Street. I became a trader. I traded all different kinds of asset classes. The energy in a newsroom when there's a big news day out there feels a lot like the energy on a trading desk on Wall Street. There's a lot of activity. The stuff we do at CNBC means so much to so many people because it empowers you with knowledge and with everything that you need to make the right decisions.
Wow, that's exciting. People are not afraid to relax. Oh my God. So this is my family's go-to spot, and it's always so good. My name is Chad Kubanoff. I've been living in Ho Chi Minh City for close to a decade now. This really is like the steak and eggs in Vietnam. I love Vietnamese cuisine because it like crosses lines all the time. Like, is this a salad? Is this a noodle bowl? It's somewhere in between, and I think that's really exciting when you see dishes like that. I was reluctant to show you this spot because I love it so much and I don't want it to get any busier. And it's so cool in Ho Chi Minh City because there's so many different styles of coffee shops, so no matter what you're into, there's something for you. If you want something that's a little more chilled, there's absolutely that. Or you want something that has a lot of koi fish, they have that as well. We can't be in Saigon without talking about Cơm Tam or broken rice, which is like the dish of this city. After 10 years of living here, my palate has completely changed as a cook and as an eater. I love this kind of eating. This is what made me fall in love with Vietnam. Welcome to my neighborhood. Let me show you a few spots I love to go to in my downtime.
Welcome back to the program. Let me take you back over to what's happening in Asia right now as we absorb the Trump tariff impact. You can see here major markets are pulling lower, losses accelerating for Japan's Nikkei 225, which is now down around 5% off the back of this. Hong Kong's Hang Seng also 1.5% weaker, but the interesting outlier here is the Shanghai Comp. You can see still holding on to gains as it was in the last 30 minutes or so. The Shanghai Comp up by 0.24% right now. In terms of where the other losses are being concentrated, well, it's another day of losses for Singapore, down more than 2%, and the Kospi in South Korea also 1.82% weaker. Of course, all eyes on the Nifty 50 as well. You can see India's market pulling down 0.63% weaker as we track into the RBI decision in just a few moments' time as well. Of course, we're going to be unpacking that with our Sri Jagaraja in just a short while. Also wanted to flag how the cryptocurrency space is doing right now as well. And we have seen digital assets under pressure, with Bitcoin retreating as escalating tariff tensions and global recession fears spark a flight to safety. What we're seeing here is Bitcoin at 75,894, pulling down by about 1%, and losses right across the crypto space as well. U.S. crypto companies still down in extended trade after tumbling sharply in the Tuesday session as well. The likes of Coinbase, Riot Platforms, Mara Holdings, and MicroStrategy all down by around 3+%. And adding to the shakeup, the U.S. Justice Department is disbanding its national cryptocurrency enforcement team. In a memo, the Deputy Attorney General, Todd Blanche, ordered prosecutors to narrow the department's crypto focus, shifting attention away from broad regulatory violations towards targeting criminal use by terrorist groups, drug cartels and organized crime. The shift comes as the Trump administration has promised to turn the US into a global crypto hub. And amid all of the uncertainty, the Binance CEO Richard Teng also weighed in on X overnight, saying the resurgence of trade protectionism is fueling global volatility, and crypto is no exception. The CEO noted that while short-term stress may weigh on sentiment, it could also accelerate longer-term interest in digital assets as a non-sovereign store of value during times of economic upheaval. Well, let's unpack all of this happening in the crypto world with Rifat Mahasna. He is the Middle East and North Africa CEO of OKX, joining me live now. Rifat, so good to have you on today, and thank you so much for walking us through the collapse that we're seeing in the crypto space right now. Obviously, a marked pullback in Bitcoin, but just give me your headline take on how the crypto space has responded through this very significant period of market volatility that's played out over the last few trading sessions and in reaction to this latest round of Trump tariffs.
Great. Thank you for having me. Glad to be on the show. I think this is an example of we're truly seeing that crypto is no longer immune to global markets. It is interconnected to global markets. When there is an incident or an event that triggers market sell-offs, crypto is not going to be immune from that. And this tariff impact we have seen over the last week has caused some money to exit crypto, naturally, like other assets. However, we still do think that as you go forward or within the longer term vision, the use case of crypto and the investment case of crypto hasn't changed. So while this is a short term impact or hit, I think in the long term, nothing has changed with the industry. The industry is actually improving on the regulatory side, on the adoption side, and on the entrance of more institutional funds into the crypto industry. So I think this is more of being in line with global markets. However, I do think for the future, nothing has changed in terms of the fundamentals of the industry.
Rifat, just how do you think investors are actually using Bitcoin in this environment? Do they see it as a store of value? Is it a risk asset? Or, okay, we're going to bring our viewers across some breaking news as well. I want to go straight out to Sri Jagaraja in Singapore with the latest on the RBI. Sri, what are you seeing?
Dan, as expected, the Indian Central Bank, the RBI, Reserve Bank of India, cutting the benchmark repo rate by 25 basis points to the headline 6%. There was some speculation that there would be some front loading and there would be a larger one-off 50 basis point cut, but that did not happen as widely expected. 25 basis point cut, and we are looking at the headlines and we're looking at the commentary from Governor Malhotra about the future, about guidance, and about whether there is a willingness by the RBI, by the Indian Central Bank, to do more, given the external risks to India. Having said all that, we're also looking for the growth projections and if there is any revision or downgrade to the estimates, which seem to be around 6.5%, 6.7%. That's the constructive case. But I was speaking to Nomura and Sonal Varma earlier, and the broad consensus amongst economists, and given the external balance of risks, is that 6.7% headline growth for 2025 is at risk. And Sonal Varma at Nomura putting it at 5.9%. So this is going to be potentially a problem for India, and especially a problem for the export sector at a sector level. Pharmaceutical, that industry was suffering today because President Trump reiterated that there will be tariffs on pharmaceuticals. IT services is also in the line of fire. That was a laggard today. But the offset here, Dan, as you and I know, is the tariff differential, which only stands to gain in India's favor now that we have 104% US tariffs on Chinese goods. The other issue here from the RBI, as I said, is the outlook. We're looking at the outlook statement looking out for that, rather, from Sanjay Malhotra. So just in terms of context here, this is the second time that the central bank has cut rates. The last time they did so was in February. And there is a real concern here about the external balance of risks affecting India and really aggravating a slowdown down. So the headline here is that this is one of the, oh, by the way, we also got the RBNZ. That cut by 25 basis points. So this is the new normal, perhaps. It's very clear that the Indian central bank, like New Zealand, may be keeping their powder dry, watching and waiting and seeing what develops on the export side of the equation, whether that filters through to headline growth rates and creates the conditions for slower economic growth. But at this stage, it's very clear in a post-reciprocal tariff environment, the global central banks, New Zealand and now India, are reacting and are creating more accommodative policy. We're waiting to see the headlines from Governor Malhotra to see if there is any willingness or intention to do more and to deepen the rate cut cycle at the RBI. But from the here and now, many are projecting an additional 50, if not 75 basis points of cumulative cuts, possibly back-to-back over the course of 2025 by the RBI. I'll leave it there, Dan. Back to you now.
Sri, really appreciate you bringing us across that breaking news, and we'll have to follow the numbers over the next few weeks and months to see exactly how these latest tariffs translate into inflation, not just in India, but globally. Thanks again, Sri. Okay, let's rejoin Rifat Mahazneh. He is Middle East and North Africa CEO of OKX. We were just in conversation before we brought our viewers that breaking news on India about how Bitcoin has been used by private and institutional investors, and the wider crypto space has been utilized through this most recent sell-off. Rifat, I want your take on what role Bitcoin has played in this sell-off, and whether or not you think prices are likely to continue to pull lower from here, given the fact that some have suggested that Bitcoin is perhaps decoupling from risk assets here. What's your take?
Yeah, I'll put the case for the two sides of this. So on one side, Bitcoin's use case hasn't changed, right? The scarcity of Bitcoin is not going to change with regards to the tariffs. It is fixed. It's there. And Bitcoin itself is not being used as a trade currency, right? So in some cases it might, but it's much less than other currencies. The other side of this equation, however, is like there's much more integration happening today between the traditional financial system and Bitcoin, either through investments or ETFs, that yes, it will not be immune to it, probably in the short run. However, the use case of Bitcoin as a store of value and its scarcity has not changed. So that, for at least for the long run, we don't see any changes with regards to that.
How are family offices and sovereign funds in the region approaching their own exposure to crypto and Bitcoin at this point?
It's a brilliant question. So in this region specifically, I think the Middle East region obviously is home to many of the world's leading sovereign funds. Most have been looking at how could they enter the space in the most regulated and risk-controlled manner. I think that when they're evaluating entry into the crypto space, each sovereign fund has its own policies and risk controls that they need to monitor. So they're looking more at countries or markets where regulation plays a key part. And definitely the UAE is one of these key markets. You've seen in the region, the UAE leads on this when it comes to having multiple regulators in the same space. And that definitely helps from a sovereign wealth fund's perspective. Most of the funds now are looking also at how much integration has been going on between Bitcoin and global markets. So ETFs definitely play a role. So I think the future for that is it will continue to grow. I do believe more sovereign funds will enter the space as they get more comfortable with the industry actually being much more regulated than before, having the right fundamentals and trading products for such sovereign funds. And I think that we've gone a long way for the last few years, that we are now ready to see more adoption from sovereigns or sovereign wealth funds in this case.
Indeed. Indeed. And I mean, just look at how the more, I guess, traditional risk hedges have performed through all of this. Gold has also held up. It's had some retracement, but mostly held up. And crypto is also seen as an alternative risk hedge, at least for some. So just with regards to prices, I know you don't like making a price call, but I might just try and pin you down on this, just given the volatility that we've seen. Any thoughts on where Bitcoin moves from here?
Well, true. I don't like to make predictions because it's not our main mission to make predictions. However, I'll come back and say again, the fundamentals hasn't changed, right? The Bitcoin is still Bitcoin. Tariffs will, I can assure you, and we're seeing it for the last few days, have taken a hit on the price of Bitcoin. But in the long run, the fundamentals are there. The scarcity of Bitcoin is still the same. It's not a major trade facilitation asset, so it's not as you can say like with other currencies, and it still has the same characteristics that have gotten Bitcoin to this day. That being said, yes, it is much more integrated in the global market. Mining costs might be as a result go up as a result of some tariffs in some markets. That could be the case, but I don't believe that we have changed anything with regards to Bitcoin or traditional or other crypto assets for that fact. I think the use cases of those crypto assets were the same last week and will continue to do so in the next, let's say, the short term and the long term.
Indeed. Okay, fair point. And Rifat, just before I let you go, obviously what we've also seen in the region is more institutional and sovereign support for major crypto houses. Abu Dhabi, of course, investing in Binance is a case in point. What's the business opportunity for OKX in the region, and how are you taking advantage of some of the trends that we're seeing in this part of the world?
Well, look, when we looked at this region, the Middle East, and specifically at the time, the UAE stood out as a market where it has the right foundations for any crypto exchange or crypto business to succeed. And those foundations were, one of the key foundations was having the right regulatory regime, which we found in the UAE. So it's no surprise that it's not only OKX, it's multiple other firms, and not only on the exchange side. Now there is a more developing ecosystem, developed ecosystem about crypto in the UAE and the wider region, where you have exchange houses, insurers, brokers, custodians, all are either locating in the UAE or having major presence in the UAE in this market. And on top of that, talent within the crypto sector is naturally migrating now to the UAE, which adds the value proposition for businesses like ours to set up here in the UAE. We've launched our business in the UAE in October of last year, and we couldn't be happier with the results so far. I think it is a model. If you look at other markets around the world, there is still the element of regulatory uncertainty in other markets. You don't have that here. So for a business that's looking for stability and foundation, clearly, for any crypto business, not just ours, clearly the UAE provides a great platform for that, and it's not going to change anytime soon. I think the beauty of it is the country put up regulation in different forms, but it hasn't stopped there. It continues to innovate with the sector as the sector develops, and it's a very fast developing sector. So the need for regulation to keep up with the sector is much needed, and in this market we see that actually happening. I'll give you an example. Countries are now discussing crypto regulations. The UAE moved on, and there's now stable coin regulations that are in place, while this is still being discussed in other markets. So it's not only the basic layer of the crypto regulation. We've moved on now to more innovative use cases. And we look forward to such use cases around payments and real-world asset tokenizations that are going to come up now, with the Middle East and the UAE specifically being a leader of the discourse and the development of such products going forward. So the Middle East plays actually now in one of the industries, it plays one of the biggest roles in this global industry is happening out of the Middle East.
Okay, Rifat, we'll leave it there. It's a hot sector. Really appreciate the conversation. Thanks again for joining us today. That's Rifat Mahasne of OKX. And stay with us here on the program. We have more news, more views coming your way on the other side of this break. We're going to switch our focus to Tesla, where vehicles are set to go on sale in Saudi Arabia this week at a time that the EV giant is under major pressure. We'll ask, is Tesla ready for Saudi Arabia? And also, is Saudi Arabia ready for Tesla? Stay with us. Access Middle East, back in 2 minutes.
Global markets, up to the minute, front page news. Wake up to Frank Holland and Worldwide Exchange. CNBC.
Swiss luxury watchmaker Omega did send their Speedmaster Professional to the moon in 1969. More than half a century later, Omega is partnering with Swiss startup ClearSpace to support a world-first initiative, cleaning up debris from space.
For 60 years, we've been putting satellites into orbit, and we essentially don't remove them.
One of these big pillars of our DNA is of course, the space odyssey. Looking at this, Omega always been very much involved in what's happening in the sky. You know, in 1962, we had the first ever Omega in space by Wally Schirra, his own Speedmaster.
Most of our economy depends on space infrastructure. We cannot live without them anymore. So what we need to do is create an environment that is just self-sustaining. We don't yet have the exact launch date. It's probably going to be more around 2028.
Sponsored by
Welcome back. US equity futures are pulling lower. Over this last hour, we've been following the reaction in the markets to the introduction of this 104% tariff on Chinese imports. You can see here major markets all called lower. The Dow now down by 677 points. The Nasdaq down by 336. The S&P 500 down by almost 100. So all eyes are again on the Wall Street Open, where we are likely to see these declines continue. Meanwhile, Tesla shares also down an extended trade. Trump's tariffs could hit Tesla sharply, with the EV maker very exposed in China. It also comes as Tesla is set to launch in Saudi Arabia. Let's get more on this and bring in Tatiana Christova. She is Director of Central, Eastern European, Middle East and Africa Vehicle Sales Forecasts at S&P Global Mobility. Tatiana, great to have you on to unpack Tesla's move into Saudi Arabia. My first question is, why now? Do you think this is in response to a market need, or is it a political lead? What's your view?
Well, good morning. That's a very good question. I cannot tell you a lot about the political side of the story, but the economical side of the story is definitely, yes, Saudi Arabia is really for Tesla, for sure. It was a very interesting situation where we had Tesla sales, some good numbers actually, especially in UAE, in the Gulf countries, at least in another one country, but not in the biggest one, in Saudi Arabia. So definitely that is a very important move for the whole Gulf region. We also assume that in the coming years there will be some good demand for the Tesla vehicles. We're pretty sure that there is like accumulated pool of customers who have waited for Tesla. I always say like not available makes it desirable. That's probably what's happened in Saudi Arabia so far now. So I call it also like Tesla Club. So people who really they're expired by the technology Tesla is bringing. So there will be definitely some good demand for Tesla vehicles in the coming years. Do not forget, Tesla vehicles still have a very good technological advantage. We closely watch what's happening on the side of the technology, especially in China. However, Tesla won't be a pioneer on the market. In other countries, it was very often like the first one. In Saudi Arabia, not anymore. BYD vehicles are known on the market, even if there are not only BEVs on the market, but also there are some good technologies in the development, local BEVs, which are in the process to come to the market and will launch already, let's say 2027. Yeah. So it will be a hard start. It will be an interesting development at the beginning. We expect probably between 10 and 15,000 units in the first 2 years, including the current year. And after that, it will definitely face very strong competition from the side of locally manufactured competitors and also China vehicles.
Right. So Tatiana, just expand on that for me, because at the moment, what we see is EV penetration sitting at just 1% in Saudi Arabia. This is a country that loves big cars, wide open roads. It has very limited EV infrastructure, and just locally, culturally, I've spent a lot of time there. I mean, what you see is Saudis really enjoying driving, and they enjoy driving gas-guzzling cars. So is it reasonable to expect that Tesla is going to be able to build sizable market share in Saudi Arabia? And what would it take to get there? Will we see localized investment or localized manufacturing, for example?
That's a very interesting idea of localizing any content of Tesla. There is no clear information about that right now, but it was promised to us in the coming days. Let's see. Let's wait and see. In terms of market share, in general, we expect the BEV market in Saudi Arabia to develop from even below 1% to 30% by 2035. In other countries, we have a totally different development. But in other countries, we have so-called regulated markets. That's not what we have in Saudi Arabia. In Saudi Arabia, this is more natural demand or a demand in the country, like you described it, more focused on large cars, gasoline-driven cars. So the BEV trend is definitely there, will develop pretty quickly, and Tesla will support the BEV development in the country. But with 30% of the whole BEV sales by 2035, it's probably not so easy to reach high volumes. So we do not expect an extremely high share of Tesla in Saudi Arabia, especially in the mid and long term, where SEER will definitely take the lead on the electric market.
How much of an edge technologically will Tesla have over rivals like BYD and Lucid, which also have growing interest and market share in the kingdom?
We compare four major competitors here. It's Tesla, it's SEER, it's Lucid, and it's definitely BYD. Lucid is already available on the market. It's exactly the large car like you described. Tesla will be able to offer Model S and Model X, well, at a very, very expensive price. So pricing is still important. Do not forget that Saudi Arabia is a large market, also large market in terms of vehicles. The biggest segment is B and C, and this is where Tesla cannot offer any proper vehicle, and we do not expect it to come to the market anytime soon, if at all. Another open question. So as long as Tesla operates only in this high segments, it won't be able to reach even higher volumes. In terms of other competitors, yes, Lucid only big cars, more expensive cars, but with very aggressive price strategy. So with the time, they will offer also more affordable cars and also more affordable large cars and large sedans. Same SEER, covering a lot of different segments from D to E with sedans and SUVs. And with the time, we do expect the share of SUVs to grow, and BYD with a really wide variety of cars on the market. So it's pretty complicated for Tesla with two mass market models and two large models, and then some special models like Cybercab and Cybertruck. It will be hard competition in the mid and long term for them.
Okay, well, let's see what Elon Musk does. Tatiana, I appreciate the conversation. Thanks for joining us today.
Thank
Tatiana
you so much.
Christover there from S&P Global Mobility. Okay, before we go, let's also give you a live look at how Europe is set to open the trading day as well. A lot to keep in focus here as we see this latest round of escalation between the US and China. Asia markets have been pulling lower. Oil heading towards $55 a barrel. US equity futures also down. The losses expected to continue when trade gets back underway in Europe. Germany's Xetra DAX bearing the brunt here, down more than 700 points. The Spanish IBEX off by 333, the Paris CAC down 240, and London's FTSE also expected to open almost 200 points lower. That wraps up this edition of Access Middle East. I'm Dan Murphy in Abu Dhabi. Stay with us here on CNBC. Squawk Box Europe is up next.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show, Squawk Box, CNBC.
CNBC meets David Beckham.
For a long time, people wanted me to do the life documentary, but I'm not very good at opening up. The things that I've been through in the past, I've kind of put in a box, locked it up, and thought I'm never going to have to talk about it again. And I was happy with that. But I didn't realize how important it was for me to actually talk about this stuff. So I opened up and talked about things that I'd never spoke about before, like, injuries and worries and things that went on throughout my career, the sending off and how that made me feel.
When you talk about the sending off and the reaction to it, when you look back, what kind of mental resilience?
Well, I'm really glad social media wasn't around back then, because it was bad enough then. It was challenging, and when I look back at some of the footage, some of the archive stuff I'd never seen before, and it was hard to watch, and I get emotional talking about it.
The day's top stories driving Wall Street. Brian Sullivan joins Kelly Evans. Power Lunch.
CNBC.
I'm gonna show you the way Vietnamese people enjoy a coffee in the morning. I live here and I have to say that I love the traffic here, which seems like a chaos to foreigners, but it's actually an organized chaos. Everything works. Xin chào! Hello, my name is Khánh Vi. I'm a content creator and a TV host from Vietnam. Here we are at District 1, which is the central of Ho Chi Minh City. I think this is one of my favorite spots in the Independence Palace. This is the way of selfie for Gen Z. 0.5. I'm originally from the north central province of Nghệ An, but I've stayed in Ho Chi Minh City for a couple of years now. Ho Chi Minh City has such great energy, and you can feel that when you come here. Nguyen Huệ Boulevard, and I'm so excited to bring you around our largest city in Vietnam. And here's what I do in my downtime.